just pointed out, and many others, the real yield. John, what do you take of a real yield that won't budge higher?
Financial conditions are still loose. And Lisa, that's the story here. We're pricing in more hikes, but financial conditions are still loose.
And the real key question for the Fed, for the ECB, for, frankly, all of the central banks around the world is employment. How much does that pick up? How much do we get an offset to those higher commodity prices from wage gains? 8:15 a.m. we get the U.S. October ADP employment report. It is expected to soften just a bit. I don't know how much we can actually derive from this when it comes to Friday's report. What I'm looking at, participation rate. How much is it coming back to where it was pre-pandemic? It has remained subdued. And then, of course, employment costs. How much are they also going up? Wages, especially as you see an increasing shift to power for the labor dynamic. 8:30 a.m. To me, this is actually one of the key moments of the day. The Treasury Department of the United States is planning to release its refinancing announcement. The expectation is for the first decline in debt sales in the United States going back to the direct aftermath of the 2008 credit crisis. How much does this mean? Perhaps a lesser deficit. How much does this mean that going forward, any taper gets offset by just less supply sold by the U.S. Treasury Department? And then at 2 p.m., this is a biggie. FOMC releases their policy decision, the Federal Open Market Committee. And then, of course, Fed Chair Jay Powell gives his press conference. Two-year yields have actually come down recently, as Tom was talking about. And John, part of the reason why is the pushback that we're getting from the likes of ECB President Christine Lagarde, but also the Australian Central Bank coming out and saying, yeah, we're going to give up yield curve control, but don't expect us to hike rates anytime soon.
Chairman Powell coming up a little bit later. Full coverage, special programming. Bloomberg Surveillance, the Fed decides on TV and radio. A little bit later this afternoon. Tom, what do we do when a friend moves back to New York City? What do we do for them?
Well,
what's our special welcome?
Well, to me, the special welcome is to suggest to them that they go beneath 59th Street.
Yeah.
I think that's, a good idea. Just,
have you taken the advice?
Drop down into
to your favorite McDonald's?
No, drop down into deepest lower Manhattan, like the 30s.
Okay, the 30s.
Murray Hill.
Murray Hill.
Yeah.
Murray Hill is what you'd suggest for David Stubbs.
Deep and lower, yeah.
Okay, let's ask what David thinks about that. David Stubbs, Global Head of Thematic Investing at JP Morgan Private Bank. David, welcome back to New York City, sir. I won't ask you about living in Murray Hill. Let's talk about this market. The Fed decides a little bit later. What are you looking for, David?
Well, firstly, for the record, John, I used to live in Murray Hill. Two wonderful years at 29th and Lex. But there we are. We're expecting the Fed to fulfill market expectations, tapering 15 billion a month, probably pushing back significantly on the fact that the end of tapering will immediately bring a rate hike. If you look at some of the conditions of look at medium-term 5-year and 5-year inflation expectations, they're still contained. Look at the prime age employment to population ratio or the participation rate. You do see a gradual recovery, and that's before I think the impact of schools going back, of increased availability of childcare, really starts to impact the female labor force. That's actually where a lot of the workers have left. It's actually on the female side. We are expecting them to come back into the labor force over the next 6 to 9 months. For us, that means that maybe the first rate hike is maybe late 22, not in the summer.
David, what's so important here is JP Morgan has framed a courage to stay in the market. What do you say to people now scared stiff?
Tom, there's always reasons to fear things in the markets. At any time, you can look forward to next 6 to 12 months and find many negative catalysts. I mean, the first thing, of course, is just look at the incredible strength we're seeing in earnings that are surprising the market, surprising all the analysts. This quarter, we've seen again, major upgrades to revenue on the top side and tremendous cost control, even in an environment of difficult inflation for input costs and for the labor market. We still see companies delivering on that firm level productivity, still putting new technology to work. And of course, you have other things coming into play now. Major buybacks, for example, planned. And as you were saying in the previous segment, financial conditions are still very, very loose. Look at the high yield market. There's almost no defaults in the last few months. Trailing 12-month default rate very, very low. This is an economy that's still primed for growth. Earnings still rising. Fixed income, a difficult place to be with rising yields and tight spreads. That's why we remain overweight equities.
There's a question not only about monetary policy, but also fiscal policy, especially on the heels of the election that took place yesterday in the United States. How much do you expect the Democrats to come together with some sort of fiscal proposal that does not include materially higher taxes in a way that perhaps has not been priced into, yes, a buoyant market, but perhaps a market that could be even more buoyant?
Well, you make the good case, Lisa. The entire year, we've had about a $5 hit to S&P earnings from the expected corporate tax changes. Obviously, we see the discussion now moving over to personal taxes and, in general, a smaller package, but a more paid-for package. I think primarily what the market wants to see is fiscal policy addressing America's challenges. America needs the infrastructure, so let's get on and pass it. Firstly, and then I think also America understands that the Democrats have certain priorities and wants to to pay for those priorities in a responsible way. I think it would be a bigger hit if these things didn't get through at all than if they get through with certain tax measures that were unpalatable to certain parts of the market. I think the bigger picture here is that you put the two bills together, there's still a modest amount of fiscal support over the next couple of years, and without them, the big question mark is America going to address its challenges both in infrastructure, both in climate change and everything else that it faces? That's what the Democrats were elected to do. I expect them to eventually come together and do it.
Do you expect them to be successful then? What you just said is yes. So I'm trying to understand how you get exposure to that theme right now, David. What are you doing to get exposure to the success of the Democrats taking on the challenges that you just wrote out for us?
Well, firstly, John, it's not clear exactly what will be in the composition of the bill. Of course, there was the framework. That, of course, seems to be a framework that can be partially changed. I think the market has been positioned for a while for this, for continued fiscal support. Infrastructure plays, for example, would be an obvious one. But, John, I'm not sure, actually, if this is the biggest issue for the market right now. I think the biggest issue is what is going to be the strength of growth next year? Will the shortages in things like semiconductors, the turmoil at the ports, the trucking shortages really start to impact growth? There's some evidence of that. And will margins compress? This is probably the biggest deal. Will margins compress based on some of that cost inflation? Our bet is actually no. The margins are high, above their 5-year average in every sector right now. We think they're going to actually be maintained. And that's why we think earnings growth, although will decelerate as we go into the mid-cycle, as we always do, and the earnings valuations may come down a little bit, the market still has upside from here based on those fundamentals, no matter what happens in Washington, really, outside of some huge shock.
David, it is good to have you back in New York City. Thank you,
John,
sir. David Stubbs at JP Morgan Private Bank.
I'm sorry. We got to do this. I mean, David Stubbs in New York, it screams. We got to get out the Amex, go nuts. Surveillance lunch, 2nd Avenue Deli.
Which one? Which street? Just the deli on 2nd Avenue? Or is that the name of the deli?
No, John,
2nd Avenue. That's the name of the deli.
It's
just in case anyone's confused.
Lisa, please.
Go for it.
We
just
got
in
two
case
tourists
anyone's
here.
confused.
They got foreign accents, Lisa. What can I say? John, the pastrami deviled eggs, 2nd Avenue Deli.
Okay. I've lived in more of Manhattan than you have. That's for sure. And I've seen more of Manhattan than you have.
Okay.
David's
it's, the tirade coming. Okay.
Maybe David will take us to Pavillon. That's sort of Murray Hill.
Call Dr. Phil for us.
Tom Keene, Lisa Bravitz, and Jonathan Ferro. I haven't lived in Murray Hill. Equity futures down 5, down 1/10%. Can you see me in the sports bar of Murray Hill, Tom, on a Saturday night?
It's just you watching the
Can you
Patriots.
imagine that? Wearing my college hoodie from years ago. What is that about? I'll never understand
John, I looked at a place once across from where Katharine Hepburn lived.
Grown adults wearing what they used to wear as students. Anyway, if you want to explain, you know where I am, on the Bloomberg Terminal. Yields in a basis point, 153.48 on 10s. they already are. Alicia Levine of BNY Mellon coming up a little bit later on this equity market. All-time highs. It's Fed decision day. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. It's a blow to President Biden and Democrats' hopes of keeping control of Congress in next year's elections. In Virginia, Republican Glenn Youngkin defeated Democrat Terry McAuliffe in the closely watched governor's race. Youngkin was backed by former President Trump, and a year ago, Joe Biden won Virginia by 10 percentage points. At the end of the Fed's policy meeting today, the central bank is likely to announce it will start reducing its asset purchases. And Chair Jerome Powell will probably say that the tapering is not a step towards raising interest rates anytime soon. Policymakers may also tweak their statement to reflect more concern on inflation. Hong Kong is in final talks with Chinese officials about reopening their shared border. That's according to local news media reports. It would be a major breakthrough on reviving travel exchanges that are crucial to Hong Kong's economy. Discussions are said to be focused on whether Hong Kong will adopt the mainland's health code system that classifies people as green, yellow, or red. And in sports, the Atlanta Braves overcame years of frustration to win the World Series for the first time since 1995. They beat Houston 7-0 in Game 6. The Braves' Jorge Soler, who hit 3 home runs in the series, was named Most Valuable Player. An almost 3-week-long strike against Deere will continue. Members of the United Auto Workers Union rejected a deal with the farm machinery maker. That illustrates the growing willingness of U.S. workers to hold out for better terms. Deere's latest offer included larger pay hikes and a signing bonus of $8,500. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit Search Go. Find answers now. Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
We're going to wait for every vote to be counted, and that's how our democracy works.
I'm here to tell you that we're winning. We want every legal vote counted.
This was tight. The news is it wasn't meant to be tight. Phil Murphy, the Democrat incumbent New Jersey governor, and Jack Ciattarelli, the Republican gubernatorial candidate from New York City this morning. Good morning. Tom Keene, Lisa Bravitz, and Jonathan Ferro. Your equity market down 0.1% on the S&P. We're -4 in the bond market, 152.96 on 10s. Yields in a couple of basis points. It's Fed decision day. The front end of the curve in focus. The commodity market in focus too. This administration leaning hard on OPEC Plus to do something. Will they? We're down 2.4% on crude to 81.91. And stock of the morning. Can we take a little look at Expedia, or rather Zillow? In the pre-market.
Zillow, yeah.
I've got Expedia on the mind, Tom.
That's okay.
Expedia on the mind because I'm booking a vacation
I was
at the
about to
same
say,
time.
where are you
Take
going?
a little look at Zillow. Can we just rewind and start
Going
again?
to Murray Hill for your
70. They got hotels in Murray Hill, Tom. We're down 18, but I'm going to get in trouble for that. We're down 19.
Probably.
Back on the rails. We're down 19% on Zillow. Zillow,
I have no sympathy.
shutting
I'm
its
sorry.
home flipping business,
No
Tom.
sympathy.
They've got to sell 7,000 homes. I love the commentary from the CEO. We wanted to be a market maker, not a market risk taker. I think at the time, Tom, everyone was saying that they would become a market risk taker.
I got to I'm not going to give my opinion. It's just children playing.
You think this is children playing?
It's just a joke.
I'm not going
Jack.
to give my opinion. It's just children
Can we
playing.
they bet big
Well, I
on
never
house.
know, Lisa, when he's
they
been
bet-
serious or not. Go on, Tom.
They bet big on house flipping, right?
Correct. And now they're
Okay.
pulling out of the business.
And taking a write down of as
Okay,
much
why
as
is that different than
$560
Robinhood?
Stock
On it-
down
with a tangible
19%.
asset,
25%
it's
workforce
basically on a tangible asset, the Robinhood of housing.
Is that how you describe it?
That's why I don't know, you know.
But he has no opinion.
No opinion again.
Can we get going here on politics?
70.81. We're down 19%.
The
Tom.
9 o'clock hour, I will grill Mayor Adams of New York City on his police force. To me, that's the emotion of New York City this morning. And maybe that goes nationwide, including in a very emotional Minneapolis and St. Paul, with perspective forward for the president. Jack Fitzpatrick joins us from Bloomberg Government. Jack, I don't want to go into the election returns. We're all sick of it. We've got New Jersey, I guess, to worry about as well. I want to talk to you about how President Biden speaks to the Democrats on Long Island that may give it up to Republican district attorneys, how they speak to the Democrats in Minneapolis, how they speak to the Democrats in Kentucky. What does he do?
It's a tough issue for Democrats on the social issues, on issues like policing, probably looking at Virginia on schools. Really, I think the president at this point wants to shift the attention away from some of the more divisive issues and not talk about it quite as much as some other more progressive Democrats may want to, and try to get a piece of legislation passed so that he can sign it into law and focus more on an economic recovery.
Then let's bring it back to your wheelhouse. Can they whip the votes into legislation and successful law given the outcome of the past 24 hours?
The past 24 hours does not help them at all. I would expect they're going to continue to try to move very quickly because especially the Virginia election results can be a bit of a Rorschach test where progressives say, see, we need to do more. Moderates say, see, we need to do less. Each side has their own views on what that loss means for them. Clearly, Democratic leadership wants to move very quickly, and if they can sort out the complications with the SALT tax, the state and local tax deductions, and a couple other things on the tax fronts, yes, it is possible for them to whip the votes, and that's really what they want to do, is to have some sort of accomplishment that they didn't have to campaign on in Virginia.
Jack, did this election show the power of the middle, the power of the independent?
If not the independent, yeah, the middle, the moderates. If you look at the results in Virginia, even in the suburbs that Democrats really dominated in the 2018 midterms, in the 2020 election, it wasn't just a matter of low turnout for Democrats. The numbers are pretty high. They just moved as percentages toward Republicans. So the issues are there that are more persuasive for Republicans than for Democrats right now, which is one reason why on Capitol Hill they want to change the subject with an accomplishment for Democrats on the economy rather than the social issues that have been really tough for them.
To push that forward, Jack, are the strategists who you're speaking to saying that it's more likely that Democrats get a lot more done before the 2022 midterm elections? Because frankly, there has been a big flag, a warning flag sent to the most progressive members of the party.
Yes, there is plenty of time for them to have really significant accomplishments between now and November 2022. The time frame for this social tax and spend reconciliation bill and the infrastructure bill that has been stalling, even though it passed the Senate, is much, much sooner than that. That's one reason why Virginians, Tim Kaine said specifically, would have been really, really nice to have gotten something signed into law before this Virginia election. But they can do this in a matter of weeks, if not a couple months, and have something to act on a year from now in the midterms.
Jack, let me give you some micro reality. Dearborn, Michigan, the son of a Lebanese truck driver, grabs 3 degrees, mostly out of Ann Arbor, does really well, runs for office, actually wins, and Abdullah Hammoud is the new mayor of Dearborn. He supported aggressively the senator from Vermont. How does he and the rest of liberal Democratic Party politics move to the middle? How do they actually affect that?
I'm not sure if it's a matter of those types of candidates moving to the middle, but there is a reality check when they have to decide how to work with the centrists in the Democratic Party. I mean, there are key races coming up, like Pennsylvania, where you may see somebody like John Fetterman run on a pretty progressive platform in 2022. I think it stands to reason Democrats still are depending on those progressives. The question is when they have to negotiate with Kyrsten Sinema and Joe Manchin, how much do they leave off the table rather than those types of candidates moving to the middle themselves?
Jack, just quickly, tight for time, the president's schedule today, what is it?
Good question.
The president's schedule today, I've got to admit that I've been very focused on Capitol Hill, and I'm a little off of Europe.
No problem.
I may not have an update for you.
Jack, it's surveillance. You can make it up.
Jack Fitzpatrick.
Just invent the schedule.
Don't do that, Jack. Please don't do that. I've been fighting that for years. Thank you, Jack, down in Washington. Thank you very much. Lisa, when we hear next from the president, it's going to be very interesting.
Yeah, I was actually looking at his agenda today, and the only public event on his agenda is meeting with his COVID task force. So really interesting to see how empty it is when he's dealing with oil prices, when he's dealing with Democrats at home, when he's dealing with the aftermath of people saying, what did you do that we all lost?
I see also lunch at Ben's Chili Bowl at 11:30.
Thank you, Tom.
That's what you see in the agenda, Tom.
Yeah.
Just in case someone believes you, do you want to
Jen
clarify?
called me and said, what should we do? I said, you got to get back to America. Go to Ben's Chili Bowl.
Jen didn't call me. Futures down 4 on the S&P. We're negative a 10 from New York City this morning. Good morning. Tom Keene.
Where do you go with this?
Lisa Bravitz. Jonathan Ferro. Got no idea. More to come, though, from New York. This is Bloomberg.
stress is there at the moment amongst the asset managers that actually some of the ESG labeled products, then if you probe, are not green?
Well, look, there is some stress, and it's great that there's that scrutiny, and there's that skepticism or healthy skepticism about ESG labels or sustainable labels. And that, again, is one of the reasons we're having this ruthless, relentless focus on net zero, because in the end, look, we can't stabilize the climate unless we get to net zero. And it's a simple, these are hard numbers. Your emissions are either A or B, they're going up or down. And if they're going down, are they going down consistent with the science? We anchor it in the science, the same science the UN and others use for the 1.5 degree objectives.
Should this not be compulsory? Should we not have regulators coming in and saying, look, this is a new definition, you stick by it, and we're going to measure it?
So I think it's a great question. So let's look at what happened with TCFD, climate disclosure. 6 years ago, you and I were in Paris. We talked about this. We talked of other things. Now that's moving to become mandatory.
This week on Bloomberg Television and Radio.
We are on the verge of a disaster.
Join us live from Glasgow for coverage of the COP26 Climate Change Conference.
People are beginning to build some momentum, I think. The question is, will it be enough?
We'll speak with global leaders, keep you up to date on progress and setbacks, and analyze what it all means to you.
We're going to need to see some real action.
COP26, the UN Climate Change Conference. This week on Bloomberg Television and Radio.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
It is Fed Decision Day this Wednesday morning. Good morning to you all. Here's the Wednesday morning price action. Equity futures come in 3. We're negative about 0.1% after 4 days of gains and another all-time high at a close yesterday. On the Nasdaq, we're positive about 1/10. On a Russell, we're up 2. We're also positive about 0.1%. For this equity market, since September 22nd, the last time the Fed met, up 5.35%. Equities up. At the same time, we've been pulling forward and pricing higher the potential for a rate hike or 2 from the Federal Reserve. So switch up the board. We've had a 22 basis point move on the front end of the curve since September 22nd. 2s right now, just short of 45 after breaching 50 in the past week. Yields come in again a little bit at the long end on 10s by 2 basis points to 152.78, on 30s at 193.76. Now, Tom, this is important. If you want to tighten financial conditions, can you get it done with rate hikes? Because we're pricing them in, Tom, and these financial conditions are staying loose.
John, over at the board, folks, for those of you on radio, John probably hasn't seen this headline out moments ago. Mr. DeCoste, John, of the ECB. And we have a winner, John, in our new word after transitory.
Go on, fill me in.
You can use this on the data check. The new word is lengthier.
Lengthier.
Inflation transitory, but lengthier than expected.
Raises the question, doesn't it, Tom? How do they move away from this T word at this meeting today? And Lisa, how do they move away from this T word without validating the price move at the front end if they don't want to?
And if they don't move away from that word, how much do they lose credibility in the eyes of so many people seeing something very different on the ground?
And what's important here, John, is I took it in the context of we need a lengthier data check. Continue.
I will add on just a little bit more for you, Tom, just to make it a little bit longer.
Lengthier.
It's an important moment for this Federal Reserve, stuck between a rock and a hard place. And this is what we're looking for later. What's next with interest rates, and what's their view on inflation, and how does the latter inform the former? That's going to be the focus a little bit later. Let's finish on this. Just for you, TK, a bit on crude. This administration leaning hard on OPEC Plus. Will they fold? This morning, crude in, Tom, by 2 percentage points, 82.22. TK, that's the big question. Will they fold?
Well, you mentioned iron ore in China. That's a topic for another time, but I'm looking, folks, at the trend on commodities, and the trend is in place. No question about that, John.
Was that lengthier enough for you?
Yes.
Yes. Okay. 82.22 on crude. That's the cross-asset price action. Let's get you some moves this morning and check in with Romain. Morning, Romain.
Hey, good morning, John. Taking a look at the individual movers. Everybody right now is taking a look at Bed Bath & Beyond. This is your second biggest volume mover, largest percent gainer here on the day, up about 53% right now here in the pre-market. This is largely because of an accelerated buyback program that the company announced yesterday, and a deal apparently that it has with Kroger to add some of those private label brands that the company has just created to put those into Kroger's stores here. It's not really clear how this is going to affect the bottom line. Remember, you're talking about a company that in 3 of the past 4 quarters has missed on EPS big time and missed on revenue. We don't get their next earnings report into January. January, but right now investors seem to be gobbling this up. Keep an eye on that space. Keep an eye on Lyft. A surprise to the upside last night, a 70% jump here in revenue in the most recent quarter, as well as a 51% jump in ridership. More importantly, they say they will be profitable on a full year basis this year on an EBITDA basis, but nevertheless full year profitability. Those shares up 13%. Its main rival Uber reports tomorrow night after the bell. Reporting tonight after the bell will be Qualcomm. Keep an eye on them for some insight into the supply chain issues, not necessarily with their relationship with Apple, but those Snapdragon chips that are in other non-Apple smartphones could be affected by some of those supply chain issues. Flip up the board. The biggest decliner out there right now on a percentage basis, that belongs to Zillow. This is a stock down 16% over the previous two sessions, down 18, 19% here in the pre-market, finally confirming that it's abandoning that home flipping business that it started back in 2018 with a lot of fanfare and a lot of criticism. Even just a couple of months ago, the CEO, Rich Barton, was really banging the drum saying this was still a good business. They actually sold 2 bond deals backed by the homes that were part of this home flipping business. Now they're taking a $569 million write-down, a 25% reduction in their overall workforce. The share is really taking it hard. However, some people not necessarily taking it hard. Kathy Wood's taking a look at this. She's actually buying into this dip. She's actually the 5th largest shareholder of Zillow if you combine all of her ARK ETFs into this. ARK Innovation buying about 288,000 shares last night. That takes it to about 7.1 million overall here. We'll see if that pays off. We should point out this is the stock now down 51% here from its all-time high back in February. That's based on yesterday's closing price here. QIAGEN, a big deal in the deal space, but based on Bloomberg reporting, QIAGEN said to be in talks here with BioMero, its rival in France here, for a potential tie-up. There's been a lot of activity in this segment of healthcare. We'll see if this deal can get done. Remember, QIAGEN had a big deal last year to combine with Thermo Fisher. That fell apart because the tender offer didn't really meet the threshold. And a smaller deal here, but one with a lot of drama, R.R. Donnelley now apparently in a deal with private equity firm Atlas Holdings to be bought out for about $8.52 a share. This is interesting because at about 2 a.m. this morning, Chatham, it's basically its largest shareholder, said that it was willing to pay $9 to $9.50 a share. The statement out by R.R. Donnelley said, didn't even really mention the new offer by Chatham, but it did say it unanimously approved that deal with Atlas. It's about a $2 billion deal on an enterprise basis, Tom.
Romaine, thank you so much. As we can do, we can rip up the script with Abby Joseph Cohen. She is acclaimed at Goldman Sachs. She is one of the people that keeps the fearful in the market participating in David Kostin's great bull market over at the Goldman Sachs shop. We're thrilled that the advisory director and senior investment strategist at Goldman Sachs joins us this morning. Abby, I'm going to rip up the script, and I can do this for someone who wrote Aristotle on investment decision-making in the Financial Analyst Journal a million years ago. Abby, we're all getting lengthier. We're all playing the parlor game of extending the x-axis. We've been here before, haven't we?
We certainly have, Tom, and it's a pleasure to be with you and the team. Another word we could use is protracted. Basically, there are several factors now behind the inflation that we're seeing globally. Some of these may prove to be transitory, yet protracted. That includes some of the supply chain issues, but some of them do represent the sort of inflation that one gets during the course of an economic expansion. And the one that I'm looking at most closely has to do with wages. We have seen a notable pickup in average hourly earnings. And on the one hand, that's terrific because it says something about the ability of consumers to continue to spend. And it also tries to get across the idea that we did go through an extended period prior to the pandemic in which wages were not quite keeping up. However, if those wages get embedded in the economy, what we do see is that core CPI, and more importantly for the Fed, core PCE moves up, but the expectation of my Goldman Sachs economist colleagues is that we will start to see that calm down. One other point, if I may.
Please.
And that is we're still in a period where year-on-year comparisons are really difficult to do because we are emerging from this extraordinary period. Now, a year ago, personal spending was negative. This year, it's positive. So what do we think is going to happen? There are going to be some price pressures, and there are going to be some supply chain pressures as well.
Abby, let's do some Cornell mathematics here, and it's about the rates of change and the dynamics involved. And we can look at wage growth. I agree with your core theme there as well. The gloom crew speaks of abrupt. They speak of gross second derivatives and even harmful first derivatives. Your shop says calm down. State why we should calm down and avoid the fear of dynamics.
I think we should calm down for a few reasons, Tom. One is, as you point out, the mathematics. The year-on-year comparisons are really fraught right now, and we'd much rather look at an extended period of what's happening and what's happening at the core level. The other thing we need to keep in mind is that there are several factors out there, three big ones, that work in the opposite direction, that may suggest that economic growth will actually have the brakes somewhat applied even if the Fed doesn't do anything. What are they? Number one, we are seeing right now a change in fiscal policy. And I'm not talking about the packages that are stuck in Congress. What we're seeing is that the programs that were previously implemented are rolling off. And so the increase in federal spending, which was, as you know, robust and equal to about 9% of GDP earlier in the pandemic, is now going to be growing at about 1%. And if fiscal policy isn't changed, it will be down about 2% next year in 2022. So that's a bit of a break. The other thing that we have to keep in mind is that we are not seeing the sort of rebound that many had expected in terms of employment. Yeah. I'm not talking about the unemployment rate. I'm talking about the participation rate, where there are many groups of people who are saying either they don't want to come back into the workforce or they don't want to do it now. So this includes working moms who are having a problem with childcare and their kids are not yet vaccinated. It includes retirees, the baby boom generation, a very large cohort in the United States. And let's not forget the missing immigrants. In the decade prior to the pandemic, about 10% of the net growth in the U.S. labor force was due to immigration, both at the lower end of the spectrum and at the high end, very skilled people. We've seen that reduce. One more factor, if I may, and that is while the U.S. and many other nations are slowly now emerging from pandemic restrictions, China is extremely tough on these restrictions, and China has 30% roughly of the world's global manufacturing capacity. If they tighten up or stay tight, that has implications for economic growth. Everyone's been focusing on the supply chain and the inflationary aspects. Right. It also has impact on the growth.
Abby, all of this sounds fairly negative. However, I wonder if the biggest pain trade in markets is not being bullish enough because it frankly supports the idea of real yields being as negative as they are and there being a supportive backdrop for risk, at least from a monetary and fiscal policy standpoint. Do you agree that the pain trade is not being bullish enough, not necessarily being bearish, potentially failing to be so?
Yeah, the economics team that I work with does believe this will be a protracted process, that the Fed, if it does announce this afternoon, as they have signaled, that they're going to taper, they will taper very gradually, and that the rise in rates from the Fed funds level in any event could be a year off. But we've already seen, as you pointed out earlier, that interest rates have already risen in anticipation of this happening. And so the key for the stock market in particular will be economic growth and earnings growth. And here again, I would urge people to recognize that those year-on-year comparisons are going to be very difficult to do simply because we're coming from a base that was so incredibly depressed in many industries that to talk about that growth rate decelerating, still good, earnings still growing, but the growth rate decelerating, as Tom would put it, the second derivative is not what we would like. But it's still going to be a good number. And I think that's
I've just got a final question to squeeze in. Are we doing the Tom Keene, Abby Joseph Cohen Christmas special this year? Is that happening, Tom?
It's up to Miss Joseph Cohen. Her people have not talked to my people.
Can you tell us, Abby? Is it happening? I look forward to this every year. Are we doing it?
It will depend upon what Tom has to say.
Okay, well, very good.
And whether I get that invitation, I'm ready with my ugly Christmas sweater.
John, can I summarize it? I
Let's
believe
do it
Ms.
now.
Joseph Cohen just predicted SPX 6000.
Oh, dear Lord.
That's what I took out of that.
Is that your invite for the Christmas
Yeah,
special?
exactly.
Hi.
Next stage, 6K.
David, she's front running you. No, I'm
hear
sorry,
that.
David. It won't happen again. It'll never happen again, David.
Abby, thank you. It's
There
great
goes
to see you.
Joseph Cohen again. Bye.
Abby Joseph Cohen there of Goldman Sachs on this equity market. Tom Keene, the headline then for me is Lisa is sounding more bullish by the minute.
No, hold on a second.
Absolutely.
You just asked a guest if the biggest risk is not being bullish
The
enough.
biggest risk that I see broadly for risk
Okay.
assets to be destroyed would be, frankly, wages, would be inflation actually going up more than expected. These people are all coming on and saying it's not going to happen.
Okay, from New York, this is Bloomberg.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer. This week, find out how Harmeet Singh is spearheading Levi's investments in innovation.
As CFO, the one important thing is to ensure you're able to connect the dots and always think longer term.
Watch the world premiere of Chief Future Officer this Wednesday on Bloomberg.
China is a gigantic part of our economic life and will be for a long time, for our lifetimes. But that does not mean that we should be naive in the way that we look at our critical national infrastructure, the way we look at, you mentioned nuclear power, you mentioned 5G technology. Those are all legitimate concerns that any government, many other governments around the world have. But I've said this many times, it's worth repeating, I am no Sinophobe, very far from it. I think.
Do you think you're the last Sinophile in the cabinet?
No, I expect there are lots of. Look, China is a great country and civilization.
What about wind power? Would you let them buy offshore wind power? That's infrastructure.
I think you'd have to
railways.
You'd have to look at what was you're defining as strategic or critical.
I was just finishing what you were saying, Tom.
Thank
November
you.
3rd is
You did
when the
your
decision is. Just in case people got confused, I will. Just one more story, Tom.
Yeah, thank God for that.
We're at 1:37 right now.
Wrap it
into
up.
weakness. Is this where they play the music and the Academy Awards? Is this it? Do I thank my mum again? Are you in charge of this?
Is she the only one?
Kill the music. You know who's in charge here.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
If the yield curve
curve falls in the woods. Is anybody listening? And the yield curve has been falling, and nobody else has been listening. And I think this is a very, very critical message in and of itself. This is information too. When you bring rate hikes forward because we're responding to supply shocks that today has inflation higher, doesn't mean that inflation will necessarily be higher and continue to grow.
Absolutely fantastic to hear from Jim Caron at Morgan Stanley Investment Management. Some fantastic voices through the week on a Fed decision just hours away later this afternoon. From New York with Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Your equity market shaping up as follows. -3. We're down 0.06%. No drama here. All-time highs again into Wednesday. I've been saying that now for 4 straight days. Record highs, record highs. Yields in a couple of basis points on 10s to 152.96 on 2s. We breached 50 basis points. And then we come back down again to 45. Yields in yesterday at the front end, Tom, just setting us up for that Fed decision a little bit later.
We haven't said enough, John, about how the gloom crew has been humbled. I mean, they've gone silent, but seriously, I mean, as you say, 4 days, but you can almost say October.
Do you think that was aimed at you, Lisa?
100%.
No, I don't mean
100%.
No, look, it's not all about me. I know that. Carry on, Tom.
Is it not? You're sounding more constructive as the days pass, Lisa.
Look, she's on the...
Here, well, let me just put it this way. If real yields remain this negative, there is a hard argument to be made that we're facing some sort of bear market. If real yields go more positive, then all of a sudden you have a different scenario. If inflation picks up in a way that people are not expecting. That is what I'm going to say.
What are we up this year, Tom? 20-something%.
Yeah, I don't know. Yeah, give me the number. That's Lisa on the edge of Joseph Cohen. That's what we call it. Yeah. Right now, we're going to move forward as we saw the president visit with the Pope at the Vatican. We now visit with David Wilson, and it's like the Vatican of Dow theory, and we're going to do it now with transportation stocks. This goes back to the 1930s and Cowles and William Getzman driving the theory forward as well. What's it mean if the transports do better? I still don't get it.
Well, if you look at Dow theory in the classic sort of model, the idea is if you're making a lot of stuff, you got to ship it places, right? So, you know, you should see transportation stocks moving along with the industrials.
The good news.
Exactly,
okay,
and that's the point.
Great.
And sort of a variation on that theme that Rich Bernstein was highlighting the other day in his latest research note is looking at what he called earthbound logistics companies on the one hand and Star Trek-like ventures into space in the other. Now, there's been so much excitement around companies like Virgin Galactic or, you know, whoever. And, you know, on the other hand, if you look at these air freight companies, think FedEx, you know, UPS, those kinds of stocks. They are. They're moving a lot of stuff, and as a result, they're actually doing better over the the year or so than the S&P 500. Whereas you look at what's going on with these space stocks lately, they haven't even been able to keep up with the index.
Cardinal Wilson, is Amazon an air freight company?
I mean, it is to the extent that it's handling its own business. I mean, that is a piece of Amazon at this point. Now, how much they're doing for other companies and can you really buy their service independently, that becomes the issue. No doubt they're a competitor to FedEx and UPS, but a lot of that, of course, is their own business, just being able to move goods around.
It's popping.
Yeah, absolutely. So, what you got in the end is a group that, no matter how you look at it, I mean, the traditional kinds of transportation companies are doing really well. And, of course, yesterday was all about Avis Budget and bringing the Dow Transports into line with the Dow Industrials.
Hold on a second, Dave. You can't make Avis story about something that's fundamental when they basically mention the word electric and their shares shot up. I mean, that seems to be all you have to do. I'm looking at electric cars and you get an incredible rally. Is there something more here?
No, maybe not as far as that goes, but, this stock has been rising for a while, and it wasn't just about electric vehicles. I mean, if you go out and try and rent a car at the airport, it's a heck of a lot more expensive than it was pre-pandemic. And so the auto rental companies are the beneficiaries of that, and it certainly played out that way with Avis Budget.
So how much has this been priced to perfection at a time when we do see inflation and consumer prices, when we do start to see perhaps the hints of consumer pushback in areas that are getting more expensive? At what point have we baked in estimates in the future that cannot continue without more material wage growth?
Yeah, I mean, that becomes a question for the broader market. Certainly in terms of the transports, you know, I'm having visions of all these container ships that can't even dock, let alone have their goods move wherever they need to go. So you would figure that the demand that we're seeing is going to last for a while. It's a plus for that group. But, you know, the question you raised, Lisa, really kind of hangs over not only transportation, but also the broader market.
I mean, John, this comes to your point, the way you're driving your LEVC TX around Manhattan. You brought it over.
Tom, this
and
is
it's
the race.
great.
You know what I'd like, and others too? I want a subscription service to a car company.
There we go.
One brand or a collection of brands where I can pay a monthly subscription. They drive themselves, they arrive at the door, and they go away. Maybe Avis can make it, Lisa. Maybe that's what this is about. It's just a bet on the future that maybe Avis gets there first.
Is that what you think?
With an electric fleet.
Do you really think so? Is that what people are baking in?
I think about 5 people cover the company, don't they, Tom?
Yeah,
pretty small coverage.
I mean, David, you've seen this before. You've run our equity coverage for decades. And the bottom line is there's always a silly season. How do silly seasons end?
Well, not well, in short. I mean, because people kind of take a step back and say, okay, what kind of a business is there really here? I mean, they've gone through it already to some extent with autonomous vehicles and, you know, the sort of thing that robo-taxis, the sort of thing we're talking about. You know, I mean, we're not really there yet. People kind of got ahead of the business in terms of the share.
Can I editorialize, John? I got in accidentally. I was at Heathrow, John, and I got in one of these gorgeous electric cars of London, the LEVC TX, like the one you drive. Yours is in black, but, you know, it's fine. I was thunderstruck how nice the car was. I was just blown away at the way it went down the road. London is so far.
As if you had to ask for permission to editorialize, given how the show's gone over the last couple of hours.
This is our COP26 we're doing right now.
This is it.
And the bottom line is London is so far ahead with electric vehicles.
Why were we talking about space earlier? What was that about?
Space has underperformed FedEx.
Okay.
That was
Are we thanking Dave? Dave Wilson, thank you.
We always thank you.
Thank you, sir. I watched Dune over the weekend, Tom.
Did you? Seriously, what was it like?
I watched it, and I have this thing watching movies where I don't learn anybody's character names, so I have no idea. If you asked me to describe that movie,
I had trouble with it. Did you like it?
It was a long introduction to the second part, was my experience of that movie, Tom. That was it. That's like part 1 before part 2.
Is this our space coverage?
This is it. Dune.
So there we go.
I just thought I'd mention it. People interested in what I get up to on the weekend, and I went to the movie
See,
theater.
this is the difference, folks. Pharaoh's watching Dune. I had to watch for the 14th time Pitch Perfect 2.
How did that go?
That was great.
You described
we know all the
plot
words.
of that story, Tom.
We know all the words.
Fed decision day, believe it or not. Your equity market's down 3 on the S&P. We're negative 0.06%. Lisa upset about the move on Avis yesterday.
108% because they said they might add electric vehicles.
I'm not here to explain it. I'm not here to throw cold water at it. Someone bought it.
John, the way you parked that electric car in Murray Hill, it's just an act of
we come up with these stories. I'd love to just reach out to the person who bought it and find, why did you buy it? And they're going to turn around and say, because everybody else was. And I thought someone else might buy it after me. Usually the way it happens, 152.96. It's the science behind the market. Alicia Levine, BNY Mellon on This Market comes up next. This is Bloomberg.
700th anniversary of Dante Alighieri's death has triggered the work of many institutions and offered a very rich schedule of events. Today in Santa Croce, we present one of these projects that suffered a difficult start because COVID-19 has stopped the project that was shared by the Opera di Santi Croce by the Franciscan community from Florence Municipality and the Fund for Religious Building of the Internal Minister. Today, Felice Limosani's project is finally enjoyable. In the Pazzi Chapel, the marvelous architecture by Filippo Brunelleschi, the most important images from the Divine Comedy created by the French illustrator Gustave Doré. Through these images, we can live the violent emotions of hell, the weight of purgatory, and the sublime joy of paradise.
The digital humanities are a cultural occasion to exploit. Summing up, it's about merging humanistic disciplines with new technologies. I find this to be an innovating and modern tool to update culture. Cultural heritage becomes something to hand over to the new generations and not to be put aside. So it's about using technology, pixels, and binary code with a human and humanizing content.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims
How
front.
are you thinking about those dynamics?
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think the narrative on inflation is a little bit confused.
I think the markets are overly alarmed about inflation.
I think central banks are always behind markets.
A lot of economists, including myself, see that in 2022, growth and inflation slows pretty heavily.
What we have to figure out next is what normalization looks like.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowitz, and Tom Keene on radio, on television, across this elected nation. We're going to look away from the politics in this hour. David Weston will fill this in later this morning. It is about the markets, about a Fed meeting. Yes, join us this afternoon. We'll be doing that on radio, on TV. John Ferro, the markets, higher.
All-time highs on the equity market. And Tom, there's one thing we haven't discussed all morning. Chairman Powell's future. And I think we need to talk about it. When the chairman speaks a little bit later today, when he talks about the years to come and policy at the Federal Reserve, for a strategy to be credible, Tom, you've got to know who's executing it. And right now, we don't know that.
One of the fears out there, John, I want to go to published moments ago by Douglas Cass, and I love this, John, is Doug Cass channels Chuck Prince from Another Time and Place. At some point, the disruptive event will be so significant that instead of liquidity filling in, the liquidity of 2021 will go the other way. I don't think we're at this point, said Chuck Prince in 2007. John, that is the sum of all our fears.
Do you want to keep on dancing, Tom? That's the question.
I guess so. I mean, you just got to keep driving forward. Lisa, you look at this and the politics of the moment, you fold it into the markets that we'll talk to Alicia Levine about. It's about the fear people. It just hasn't happened. It is a good market.
And we have not seen the signs of a policy error yet. What could it take for a Federal Reserve to make a policy error that leads to the analogy of 2007 heading into a 2008-like event? Right now, we're not seeing it, but that, I think, is one of the key questions haunting the market.
Haunting the market is also the press conference. John Farrell, what does the chairman want to not say today?
I've got no idea, and that's the issue with the chairman today, Tom. They have held on to that T word so tightly throughout the whole of this year, and there is a belief now that perhaps they need to move away from it, and I think it's going to be really difficult for them to do that without conveying something else that perhaps they don't want to.
The convenient truth scheduled for us in moments. Al Gore will join us, the former Vice President of the United States, with his decades-long commitment to climate change. Before that, we're going to get to Alicia Levine. John, the data, let's get through it quickly. Red and green on the equity screen.
Equity futures down 3. We're negative 0.06% in the bond market. Yields in a couple of basis points to 152.96. TK, did you miss my Chuck Prince quote there? Did you miss that? You've got to keep dancing. Isn't that the quote? You've got to get up and dance.
Exactly.
I thought you just sort of let that one go. A little bit too easy. I thought it was perfect.
He blew me off in Davos once.
Did
so
he?
I don't.
So you haven't spoken since?
I remember the day that he was showing the door. I had to come in.
Yeah.
Saturday. I came in, I had flip-flops on.
You had flip-flops on?
It was Saturday. I was in shorts, and I came in and we did the show.
I didn't know you
Sunday,
had any
maybe.
flip-flops.
Special edition.
Do you think it is that kind of moment, though, Tom? Let's talk about this seriously. Do you think it really is that kind of moment?
No.
You're pushing back hard?
I'm pushing back hard.
Good.
No. I just don't know. Are we done?
We are.
That was our data check. Okay, we'll continue here, folks, and the data we'll cover here through the morning and again this afternoon for the Fed meeting. Alicia Levine with us, head of equities and capital market advisory. Alicia, how have you adjusted staggering into November?
Really interesting October, right? Because we sold off right in the beginning and we rallied hard into the end of the month as earnings came in better than expected. Look, we expect a strong market into the end of the year. When markets are up this much in the first 10 months, you move higher into the end of the year. And actually, statistically, you do so into the following year. So we're expecting a good market in 2022 as well. The interesting moves here, as you've been talking about all morning, are happening in the bond market. The fascinating thing here about the bond market is that the break-even curve is still inverted, and yet the market pricing of those rate hikes is hawkish. Those two things are at odds with each other, and so it'll be really interesting to hear what Powell says today. Incidentally, I think what happened last night electorally increases the chance that Powell is reelected.
Oh, you do, Alicia. Walk us through that.
Well, I think there was shaping up to be a big log roll about trading off some things that were important to different factions of the Democratic Party. And I think the message that was sent last night was essentially, there are more centrists here than perhaps the discussion has been in policy. And I think to that extent, keeping Powell ensures a continuity anyway that the markets would appreciate. And given the message of centrists last night, across the board, really, I think his chances have increased.
What do you think that means for fiscal as well, Alicia, just to jump in and build on what you've already said?
Well, look, I think it's harder to, I can't imagine a more dovish Fed chair, but we do know that markets test new Fed chairs, right? So I'm very pleased to see that, there's a probably increasing likelihood he will stay. His discussion today, I can't imagine him omitting the word transitory, but the bottom line is those 5 factors that he laid out back in Jackson Hole have slowly unwound to suggest this may not be transitory. The market's already pricing in 2 hikes starting in the summer of next year, so the market's done the work for him. So even if he sounds more hawkish, the market has gotten there anyway.
Alicia, how much is his credibility at risk, though, if he doesn't acknowledge some of the inflation that we're seeing, not only with respect to consumer prices, but also on the wage side?
Look, I think he will acknowledge it, but ultimately, transitory is a funny thing. It can mean different things at different times, and right now it means sustained, prolonged, but eventually will turn the other way. And I think that, there's some evidence in the real economy that this can happen. We've heard overnight Vietnam has all those Nike factories open. We have all of those GM factories open in the U.S., having chips, sufficient chips. So there are signs that some of these supply shocks are loosening up. And as you talked about the second derivative again all morning, that second derivative is telling you that perhaps the peak in inflation is over. Is it sustained? Probably. But he's going to have to acknowledge that.
Alicia, before we let you go, I am curious to get a sense of the pain trade, what the biggest potential pain could be in a market where the bears are increasingly killed off, and it seems like monetary policy is ruling the day.
So the pain trade for me, everybody coming into the fourth quarter was short the bond market, long value, shorting tech, and that's the pain trade. The pain trade is going long tech, and yields not moving where the market was expecting, simply because that terminal rate for the Fed funds rate is going to be lower, and therefore yields won't get that high. The heavy lifting on yields happened in the first quarter of 2021. We don't see another quarter like that again.
Alicia, just brilliant. As always, love catching up with you. You know that. Alicia Levine there, FBNY Mellon, Wealth Management. It's painful for you, Lisa. That feels like the pain. Every time you ask that question, what's the pain trade? Stocks at all-time highs.
You mean the morning?
It feels
Honestly,
personal.
Well, no, I'm curious to know where the heavy positioning is in a market that's getting more conviction on the overweight.
Yeah, someone wrote in about Avis and said maybe the pain is on the short side after yesterday, and perhaps a lot of that was behind that, Tom, that move in Avis yesterday.
We'll see. I don't know. There'll be a new Avis today. That's what I know for certain.
Without a doubt, there always is.
In
There's
Glasgow,
somewhere.
at COP26, there are people that have parachuted into climate change. That could not be said of the former Vice President of the United States. And with that, there's no need to mention his name. Francine Lacroix with a gentleman from Tennessee.
Yeah, thank you so much, Tom, John, and Lisa. I am delighted to be speaking to Al Gore, really the original proponent of sustainability and climate change, who for years and decades has been trying to make this a reality. Vice President Gore, thank you so much for joining us.
Thank you for having me.
Today's Climate Finance, we're focusing on the funding, on the finance, on how we transition better. I want to ask about your investment firm. This is something with a joint venture also with Goldman Sachs, and you're basically only targeting assets that are decarbonizing, which means that all the portfolios are well below the 1.5 degrees. Right. Is this how you do it right?
Yeah. Well, Generation Investment Management was one of the small group that convened this Net Zero Asset Managers Initiative, and it's now up to this incredibly large number of $52 trillion, and it's part of the larger package that Mark Carney talked about. The rules of the road are still being worked out in great detail. For our part, we are actually committed to net zero, real net zero. Some who have made this commitment are still working toward that maximum goal. And I think what you're seeing here in this conference overall is a big wheel turning slowly. I think the world is awakening to the dire danger our civilization is in, and I won't go into all that, but obviously Mother Nature is making the point very powerfully, and people are now responding, and in the finance sector, they are now saying, look, we got to be part of the solution, and we got to stop funding the problem.
How do we turn the wheel faster? So if you're an investor today, how do you avoid greenwashing? How do you avoid making the mistakes that then leads to probes saying your financial product is not ESG enough?
Well, in its essence, greenwashing is just a cheap trick that people are beginning to see through. It won't work for long. In the age of the internet, people are ferreting out what's real and what's not. It will take a little time, but society as a whole is now insisting that all of the institutions of our civilization begin to respond to this with the sense of urgency that's appropriate. And that's why you've seen this wave of ESG investing, albeit with a lot of greenwashing. And as people begin to focus more intently, they're going to insist that they do it for real and get rid of this greenwashing.
How do you measure success? If you look at some of the things, for example, investment products, I know we're waiting for a common language. Yeah. We're waiting for taxonomy. We're waiting for a price on carbon. Yeah. But how do you make sure that investors don't walk away from COP26 with a pat on the back saying, we've done the job, but let's go back to business the old way?
Yeah, I don't think that they're going to be able to do that because a lot of the large asset owners, including pension funds, are saying, we want to go with managers that are actually committed for real and not just a pretend commitment. And I don't think that there's going to be a letdown after this. I think the pressure is on. This conference or COP process includes 50,000 people, and a lot of the major commitments and progress that's being made take place outside of this plenary hall, take place outside of the negotiating sessions, but actually involve people who are in finance, who are CEOs of businesses, and they're hearing from their customers.
But how much of a problem is it that private money, as you say, is going faster than public money? And what can we do to change that, to at least align them?
Well, we need reform of the multilateral development banks, for sure. The World Bank is not yet on side. And the head of the World Bank is a perfectly nice guy appointed by the previous U.S. president or chosen by him. The staff is actually very good there, in my opinion, but they're not yet really committed to helping as they should. There is a tremendous amount of work going on to try to come up with sensible reforms, not only at the World Bank Group, but Kristalina Georgieva, I think, is a real champion here. And she is pushing hard to get these reforms in place. And then there are a whole group of other multilateral development banks, regional banks, national banks. There's a general awakening among all of them. Here's an example, Francine. If you're a business in Nigeria and you want to build a wind farm, your interest rate is 7 times higher than it is if you're in an OECD country. That's insane. Obviously, the market is perceiving risk of various kinds there, but that's what these publicly funded multilateral development banks should be doing, taking that first level of risk off of the table and speaking for society as a whole and saying it's in our public interest to make this transition faster.
Why is the U.S. not doing more? I know we have an agreement on methane, but at the same time, President Biden has been hamstrung with some of the politics back home. Why is this happening now?
Well, we still have a political battle to win in the U.S., and it's a divided politics in the U.S. and the narrowest possible majority in the Senate. So President Biden, I think he did a fantastic job with his 2 days here. And I think he's done a fantastic job in proposing a really meaningful climate package. But it's very tough when you have a 50-50 Senate and a couple of the Democratic senators are not yet on board, one from a coal state. So it's a challenge. I do think that in another couple of weeks, I think before the end of the year, certainly, this package will be passed. It may be modified again, but I think it will be passed.
Will that help with convincing China to come on board, or is it about including China?
Well, yes, I think it has to help in bringing China on board. Yes, if China can say you're preaching temperance from a bar stool, as they say, then it lets them off the hook a bit. But I'm convinced that China is serious about making its transition. They're building more solar panels and wind farms than the rest of the world put together. They're still burning more coal than the rest of the world put together, and that has to be transitioned away much faster. And they can save money by doing it. But the coal industry in China is as powerful as the coal industry in the U.S., and so it obviously is taking some time to make that transition. There's an old Chinese proverb, I'm told, that says the mountain is high and the emperor is far away. I think that some of the regional governments in China have close ties with coal and coal-related industrial operations, and it's taking them some time to get them on board. But they've introduced carbon pricing in a chunk of their society. It's due to expand. They have put out a net zero goal. It's farther out than I would like it to be, but they plan their work and work their plan, and I think they're determined to do it.
Vice President, when we see how much green finance there is out there, I had a chief executive calling it tsunami of green finance. Yeah. What happens to the companies that are not working on their transition now?
Well, I think we're in the early stages of a sustainability revolution that's the biggest investing and business opportunity in history. And those who don't recognize that and adapt to it are in commercial risk, of course, because they're going to be left behind. You remember the subprime mortgage bubble that led to the Great Recession. We now have a subprime carbon bubble of $22 trillion based on an absurd assumption that all of those carbon fuels are going to be burned. They're not going to be. They cannot be, especially because the new renewable sources of electricity are much cheaper now and will be cheaper in 100% of the world, already in 2/3 of the world.
So do you believe that once we have a carbon market, a proper carbon market functioning with prices, that it reprices private assets?
Yeah, I mean, I think that once carbon risk, the climate crisis risk is internalized, then yes, it's going to affect the value of all these assets. We've had this insane illusion that we can just ignore the impact of the climate crisis. But Mother Nature is telling us, no, not so fast. And these events are getting more extreme and more frequent, and people everywhere are recognizing it, and they're demanding action. There's still resistance, of course, and the legacy fossil fuel complex and the bankers that continue to invest hundreds of billions of dollars in it every year, they remind me of the old cartoon of Wile E. Coyote running off the edge of the cliff, and the legs keep moving until gravity takes hold. We're in that moment now. We're in a transition, and those who make the transition faster are going to do better as a result.
Vice President Gore, thank you so much for your time on Bloomberg today. And with that, I'm going to send it back to you in New York, John, and we'll have plenty more from Glasgow COP26.
Francine, thank you so much to you as well. Got to move to the data pretty quickly. 3 minutes ago, the ADP report dropped. It's a big upside surprise. 571,000. The median estimate, 400K. The previous number, a downward revision, a revised 523 from 568. It's an upside surprise here going into payrolls Friday, where the median estimate this Friday is 450K, and the range is wide. We do this every month now. The high end, 700K, the low end, 250. Here's the price action. All-time highs at the close on Tuesday into Wednesday. Your equity market futures are down 4 points on the S&P, negative 0.1%. Tom, no big moves here. Yields lower by a couple of basis points. 153.13 going into the Fed.
Very good. Lisa Bramwitz, Jonathan Farrow, and Tom Keene on radio and television. And right now, we're going to regroup with Michael McKee. We can do that because he will darken the door. Is it virtual today? You're not jetting to Washington for the press conference? No, it's still virtual. It's still very virtual. We'll have a virtuous Michael McKee this afternoon with the chairman, and then on to the jobs report. I want to go where Abby Joseph Cohen is, which is her determinant is wage growth. Combine the two. How does the chairman today deal with the inflation fear of wage growth, and how will we observe that Friday in the payrolls report?
Well, it's not just the payrolls report. We got the big number in the ECI that came out earlier this week. And so there is a lot of concern that we're going to start to see second-round effects, that people are going to look at rising inflation, and then they're going to say, we need additional raises to get past that. There's also the question of the low participation rate. As long as people aren't coming into the labor force, it gets harder to hire people. To keep that unemployment rate keep going down as the Fed wants, then companies are probably going to have to raise salaries again, and all that contributes to an inflationary cycle. So seeing how Jay Powell squares all that is going to be important to the markets.
I looked, Mike, at what Jay Powell will say today. Totally unfair question. We're hoping you don't get the last question, as you so often do. What will be the thrust of the 4 or 5, the 6 journalists in the room truly qualified? What's the mystery to economic journalism right now that the chairman can give us information on?
Well, it's the gap between the Fed's rhetoric and the reality on inflation. The Fed has maintained it is transitory.
How distant are the dots from inflation?
Well, they're quite a ways from inflation right now. They did move up a little bit, but the dot plot you should throw out, it's not fair because that was, 3 months ago. The Fed can't change its forecasts as fast as market participants. But the idea that we are looking at transitory inflation and then it doesn't go away is a difficult concept for the markets. And when the Fed says it's going to let average inflation rise for a while above the 2% target, how long is a while? The new format is the new framework is kind of less clear than the previous regime.
Mike, it seems to me that economists are the only people on the planet scared of higher wages. And I ask this in a serious way of you. Can you explain why the fear of higher wages is so deeply embedded in conventional economics?
Because of a lot of economists and of the people in this studio, Tom Keene, were around in the 1970s when inflation got out of control and we had to bring in Paul Volcker to throw the economy into recession, which is kind of the playbook that the central bank would have in that situation, as people tried to bargain for higher wages consistently, and that just created a wage price spiral. And so there is that fear that that could come back. The Fed's argument is inflation dynamics have changed, globalization has changed, the labor unions have largely gone away, and so we don't have that problem going forward.
Right now, Mike, we are facing a different political reality in Washington, D.C. Alicia Levine was just on, and she thinks that Jay Powell can have more comfort in being the next Fed chair. Are we going to see an emboldened Fed chair this afternoon?
He hasn't got the job yet, unless he has and we don't know it. So I think he will be very cautious. The last thing he would want in this case is to make some sort of slip and have a major market reaction. We've already got basically today's decisions priced into the market, the $15 billion in taper, the idea that they're going to taper. And so anything that would go beyond that, that would move markets, might be a problem for the chairman.
Mike, basically baked into the market is this idea that tapering will start mid-November, mid this month. What are they going to potentially signal in terms of the pace of this? Because the differences in economic projections there are more significant, especially as they concern when liftoff occurs.
Well, it's just math, basically. You take a look at they've got $120 billion a month that they're buying, and if they are going to cut it back by $15 billion a month, that takes you through June if they start in November, and odds are they might as well start in November. And so we got 7-8 months of reductions at $15 billion a month, and at that point, then they theoretically could start raising interest rates. So the discussion will rapidly switch to when do they raise rates. The issue is going to be, does inflation come down in the meantime, or is the Fed going to be forced to act? And one of the questions I'm sure that will come up today is, what happens if inflation starts to accelerate? Do you accelerate the taper?
Yeah, Mike, you and I have talked about that through the week. Mike McKee, thank you. Tom, is it set on autopilot when it begins? Is it a preset course? Can they speed it up? They'll say they can, but there'll be an impression in this market, I think, that we're on a preset course.
There's too many variables, John. That's the way I look at it. I mean, the gloom crew talks about macroeconomics and monetary theory as if it's a three-factor equation. It's not. It's not even a Taylor rule, which is actually fairly complex. It's way more complex with that, with way more adaptability and changes in probability.
Well, let's talk about recent economic history, Tom. Is this an FOMC conditioned by the post-2010 period or by the 1970s? Because I thought it was the former.
Well,
and now the conversation has shifted to the latter.
I'm going to go in the middle here and say it was the Bank of Japan, which went out and raised rates at one point and had to capitulate in reverse. That's the ultimate fear in this deflationary time, is we got to go higher, we got to go higher. Oops, we were wrong.
And Tom, that was what was behind the shift in the framework of the Federal Reserve. Yeah. Having some patience, having the framework there around them to ensure they have that patience. And now it just seems the conversation has shifted, Tom, just around this word transitory. Well, because it's so hard to keep repeating the same thing when the data's moving the other way.
You know, we're making jokes about it, John, but I'm sorry. The cost of the ECB today maybe gave us our new word, which I've been screaming about for months, which is the x-axis dynamics.
Lengthier.
Yeah, but they use
You know what we need, John?
Lengthier transitory.
Lengthier transitory.
We need log charts.
This has got ridiculous, you know.
Log charts.
I often say this, if you accidentally tuned in to financial news and listened to the conversations, they are utterly ridiculous.
I think that's just us.
It's not just us, though. It's the central bankers.
It's true. I agree.
It's all of it. Futures down a tenth. This is Bloomberg.
Входим в опасный участок, ответственный. Рустам поднимает тебя на жимаре. Шерпа страхует.
Очень много думал о том, что я сделал, и понял, что сделал какую-то нереальную вещь. Не знаю. Я до конца внутри себя даже не могу поверить, что я через это прошел. Состояние, наверное, организм истощен, потому что очень много физической работы. Своим вот этим поступком я хотел сказать, что только через действие в этой жизни достичь можно абсолютно всего.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer. This week, find out how Harmeet Singh is spearheading Levi's investments in innovation.
As CFO, the one important thing is to ensure you're able to connect the dots and always think longer term.
Watch the world premiere of Chief Future Officer this Wednesday on Bloomberg.
Do you see Deutsche Bank ready to pay more and pay out more in terms of bonuses too for staff to have that strong talent that I'm sure you want?
Well, look, it's a war for talent. It has been, in other cycles before. It is now. We're finding that we're competitive in that war for talent.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Live from New York City for our audience worldwide, heard on radio, seen on TV. This is Bloomberg Surveillance on this Fed decision day. And here's the price action. Your equity market down 5. We're negative 0.1% on the S&P. Into the bond market, where we have a little announcement for you. Yields in a basis point, 153.48 on 10s. Let's get to that announcement. How much supply we get from the Treasury. Mike McKee has more. Hey, Mike.
John, we have some news this morning. Treasury is cutting the size of its auctions going forward. First, let's look at what they are going to do in the first month of this refunding quarter, raising $44.1 billion by selling 3-year notes in the amount of $56 billion, 10 years, $39 billion, and the 30-year bond in the amount of $25 billion. Now, the cutbacks are these. They are going to be cutting the size of 3, 10, and 30-year refunding sales by $2 billion each. They're going to cut the 7-year by $3 billion, and they say the 7-year is being cut because that's the one that they increased the most, so they're cutting it back the most. They anticipate decreases of $2 billion a month in the new and reopened 10-year auctions and in the new and reopened 30-year auctions. So the Treasury is significantly cutting back on the number of bonds and notes that it is going to sell because it says in its release that based on the latest fiscal outlook, current auction sizes are projected to provide excess borrowing capacity over the medium term. Now, we know, of course, that the pandemic spending has leveled off and is starting to decline, and so they don't need to finance as much. And I know you've got Michael Gapin coming up. I know they will care that they are not going to do a SOFR-linked floating note, but they are going to reduce the size of regular floating notes as well. There are 2 warnings in here. One is from the Treasury Department about the debt limit, suggesting that Congress needs to make sure it gets gets it passed by December 3rd. The Treasury Borrowing Advisory Committee calling it reckless to not do that. And then in terms of the cash balance, because of the debt limit, they say Treasury expects its bill issuance to decline between now and then, because obviously they can't go over the debt limit, and that could cause problems in the short-term markets.
So, Mike, there's a little conversation that's taken place, a big one, in fact, for people on the fixed income side, as to whether everything you've just said cancels out the taper from the Federal Reserve through the next year.
Yeah, it is a tale of two tapers, and ironically, they're both coming up today. As the Fed starts to cut back on bond buying, the Treasury is going to cut back on bond issuance. And we haven't run all the numbers yet, but Stephen Stanley of Amherst Pierpont yesterday put out a note that suggested that when you look at the totality of the cutbacks in 2022 and the Fed cutback in its buying, that they roughly cancel each other out, which should leave no real rate move based on these changes today and on the Fed's taper. We're seeing some, as you can see on the screen on television, we're seeing some reaction in the bond market to these announcements, but it is probably going to fade out and be overcome by the Fed this afternoon anyway.
Mike, the expectation was for the Treasury Department to reduce the supply of T-bills in the market, short-term debt, and try to continue with some of the longer-term securities that have very low yields. Are we surprised that they didn't do that more aggressively, that they didn't more heavily weight the cuts on the front end of the curve?
Well, they are cutting on the front end of the curve when you get to the note level, but the bills they're leaving pretty much in place, except basically for cash management purposes, but except for the fact that they can't sell as many as they get closer to the debt ceiling on the December 3rd. But they are going to supplement the benchmark bill issuance with additional cash management bills of 17 weeks, and hope that they can get through this period.
The only thing you got me on was a tale of two tapers. So Yellen's saying this morning it's a far, far better thing than I do than Chairman Powell. What's the distinction between Treasury taper and Fed taper? Do we care?
Well, we don't care as much as the people on the trading desk care because of the influence on interest rates, but the Fed is going to stop buying as many bonds and notes at the same time the Treasury is selling fewer bonds and notes. If the Fed steps back, then the private market has to absorb more. In this case, the more they have to absorb is a little bit less than it otherwise would be.
Price down, yield up?
That could be, except that if the Fed is no longer buying as much and the Treasury is not selling as much, as Steve Stanley points out, it could just cancel each other out.
Michael McKee, thank you so much. Surveillance Fact, John Farrow, Lisa Bramlett, and I all at gunpoint had to read Dickens' Tale of Two Cities. He read it because he wanted to. Michael Gapin joins us on the Tale of Two Tapers now, Chief U.S. Economist, Barclays Investment Bank. How is a Treasury taper, Michael Gapin, different from a Fed taper?
I think it's mainly because the Fed is a unique holder of Treasury securities. Of course, they have different incentives, different holding periods. They're different actors. So I think it's more about, yes, on net, these two things are generally canceling themselves out, but the Fed is backing out of the market as a very unique buyer. I think that's still the main message. So I wouldn't take the net comparison too far. I do think the big news is the Fed will be tapering.
The big news is they'll be tapering, and they will be cautious and conservative, as the August institution is. In this November, how measured will Chairman Powell be?
I think it'll be fairly measured. Typically, when the Fed is tightening policy in some form, they like to offset it by giving you a little something on the other side. And I don't think that's going to be a strong pushback against market pricing. I just think it'll be an emphasis that the decision to taper and the decision to lift rates are two very different things. They have different criterion. The bar for lifting rates is higher, and that's a long way off. So I think that's going to be what he'll try to kind of soft pedal the taper message with. Yes, we're starting to taper. Yes, we're still concerned about risk to the outlook for inflation next year. Yes, there's a risk management component to this decision. But, really don't push this too far. They're two separate decisions. I think that's where his cautious will come in.
Michael, do you expect him to say that we expect a lengthier transitory period going forward?
I think that's, so you were debating this in the last segment. It kind of has become a dirty word. It wasn't in his press conference statement last time around. He didn't mention it in the press conference itself, that word transitory. It's in the statement. So yeah, I think the flavor of that has to stay. I still think in general their forecasts are all consistent, and ours are still very consistent with a transitory or temporary impulse. The duration of it is just longer than we thought. So I think they have to find a way to keep that flavor around, but maybe back away from the pure usage of that word.
What's the potential market reaction if Fed Chair Jay Powell does not push back significantly against the idea of 1 or even 2 rate hikes next year?
Well, in the short run, it may mean that the market moves to price in more hikes as they've done elsewhere. So, and as certainly they did, say, immediately following Lagarde's press conference, previously. But from the Fed's point of view, and I think they're right on this, it's a long way out for them. It's at least 6 months down the road for them, given what they know today. They don't really have any incentive to push back strongly against market pricing or confirm it. So, I think at this point, it's get the taper decision done, communicate that they're 2 separate decisions in terms of tapering versus liftoff, and kind of let the markets have at it.
Michael, frame for us the immovable force of gross excess savings, or I should say excess gross savings, and also the immovable force is everybody's moving their terminal values out to a lengthier out. Put those 2 together right now.
Yeah, I think part of it is, so there is this big pool of excess saving that's out there, and it's still, we're just really now getting to the point whether we will know whether households are going to be drawing down on that pool of saving. If they do, because really right now it's government stimulus has faded out to the point where the personal savings rate is almost back to pre-pandemic levels. So you could see a situation now where the saving rate goes below, let's call it low single digits, and we'll see whether households draw down on that. If they do, then that's a situation where you could combine that with federal spending or infrastructure spending, and you have a prolonged period of above-trend growth in the future. And depending on where inflation is, that could be a longer cycle. So I think that's how I would interpret it in terms of the contribution it could bring to demand, how long it keeps growth above trend, and therefore what it might mean for the duration of the tightening cycle.
Michael, have we reached the point where jobs markets, jobs data that we get, as we're going to get on Friday, really do indicate a shift or something true? Or are we just still seeing the comeback of a market that was so severely distorted by the pandemic?
I think it's the latter. I think this is, we've debated about forecasts and the accuracy of models and so forth, and we can do that all day. But I think this is one point where we in the economist community, I think, have been pretty consistent. We've said, I believe, it's going to take 12 to 24 to 36 months to sort this all out. So I'm still in that camp. If you look at the data, for example, the data will tell you about 4 million people were out of the job market last month because either they had COVID or they were taking care of somebody who has COVID. So that's a huge number. And obviously that rotates over time. And in terms of who's been out of the labor force, it's mainly a married couple where financial resources generally can be shared, so one person is stepping out for one reason or another. There's a lot of room for that to heal over time. We're not going to know in the next 2 to 3 months whether that changes. It's likely to be a long process. So that's my view, is it'll come back more incrementally, and it's going to take 6 to 9 to 12 months to get a good idea of where that is.
Michael, thank you, sir. Michael Gapin there. I appreciate the sound of a busy office, a busy trading floor over at Barclays.
It is, yes.
Isn't that good, Tom?
Yeah, it's
music to my ears. It's good to have you back. Thank you, sir. As always, looking ahead to the lineup at 9 a.m. Eastern Time. What a lineup it is. Bob Michael, Subhadra Rajappa, Krishna Memani. I think Krishna might have shaved since then, Tom. Krishna Memani coming up a little bit later. Krishna looking for a move back to 2s. On GDP, 2%. On inflation, 2%. Subhadra looking for a steeper yield curve here. And Bob Michael saying embrace risk through much of this year. Looking forward to this one, TK, in about 20 minutes.
I have to admit, a set of smart discussions.
Thank you.
If you can, John, ask them if they'd like to come on earlier in the morning.
I will. Did that hurt?
Start their day
a little bit
as well.
I will.
Christian's probably going to love the photo. You killed that, John.
He might not come back after that. Futures down 6 on the S&P, negative a 10 from New York. It's Fed decision day. Special coverage later. A surveillance special with Tom Keene, Lisa Bravis, and Jonathan Ferro. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. In Virginia, Republican Glenn Youngkin has sent Democrats a wake-up call for 2022. The candidate backed by Donald Trump defeated Democrat Terry McAuliffe in the race for governor. Youngkin returns some suburban and independent voters to the Republican side. That's an omen for President Biden and Democrats hoping to keep control of Congress next year. In New York City, Democrat Eric Adams has been elected mayor. The Brooklyn borough president easily defeated Republican Curtis Sliwa. Adams will immediately have to grapple with the city's COVID response, widespread inequality, and safety issues that keep workers from returning to offices. It's a new frontier for many banks managing climate risks and climate stress tests. Bloomberg's Francine Lacroix spoke with the European Central Bank's Vice Chair of Supervisory Bank Board, Frank Elderson.
A bank having a sustainability office is so 2011. We now need banks to really incorporate, and this is what our expectations are all about, to incorporate this in their very DNA, in their business models, in their management information systems, in their risk management. So for a bank, this is not some kind of a fringe. This is core.
The Bank of England has threatened to, quote, come down pretty hard on companies that fail to manage climate risks starting next year. And Cathie Wood's flagship exchange-traded fund took advantage of a huge slump in Zillow. The embattled real estate company fell 10% yesterday, and the ARK Innovation ETF bought roughly 289,000 shares, worth around $25 million. Wood's fund owns more than $600 million of Zillow shares. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
The energy crisis, there's a lack of drivers. Is there anything that you need to ask authorities to do better, or that your clients want the UK to do better?
I think we're at a moment in time where we're coming out of the pandemic, and there are a handful of things going on. I think all over the world, there are labor issues that are really a reflection of this transition out of the pandemic. There are supply chain issues. Some of this stuff is transitory. There are some secular trends that we have to watch closely, but I think we're adjusting and dealing with it as anybody else is. And I think leaders here are thinking about it the same way leaders are around the world.
When you look at the UK and, of course, some of these green investments that the UK and the City of London particularly has been really trying to pitch, you've been extremely involved in carbon offsetting. Can London really spearhead that movement?
Well, I think it's important that governments around the world partner with the private sector to try to get capital directed toward innovation in a way that we can accelerate the climate transition. And I want to emphasize it's clearly a transition.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
I was just finishing what you were saying, Tom. November 3rd is when the decision is. Just in case people got confused, I will. Just one more story, Tom.
Yeah, thank God for that.
We're at 137 right now.
Wrap it
It's
up.
a weakness. Is this where they play the music and the Academy Awards? Is this it? Do I thank my mum again? Are you in charge of this?
Is she the only one?
Kill the music. You know who's in charge here.
en lucha. Han profundizado el extractivismo en Argentina con más agronegocio, con más transgénicos, con más agrotóxicos, con más proyectos megamineros. Y ahora, como si fuese poco, han avanzado presentando un proyecto de ley que es la ley de hidrocarburos.
Wednesday, Bloomberg surveillance. The Fed decides. Will the Fed finally announce a date to start a taper? And how long will it last? Will they still view inflation as transitory? Find out Wednesday starting at 1:30 p.m. Eastern on Bloomberg.
As long as Powell says that the influences of inflation are temporary, the market, to a large extent, has to accept that. The best that we can do is we can figure out any point at which the Fed might abandon that definition.
In Lincoln there, on the bond market, and the bond market moves quickly. Lisa Bramwell, let's talk about this. We have this refunding dance come out, and the yield moves 0.45% up to 0.47%, two-year yield higher.
Yeah.
Why?
Although I do wonder how much that's in the back of the ADP report as well, because we did get a better than expected ADP employment report, and I wonder how much some of the bond moves are really going to hinge on what we see on the employment side. That said, the idea that we are going to see a tale of two tapers, the idea that possibly the taper that's announced today will be meaningless because the supply is also being reduced at the same pace.
We're going to finish strong here in this hour with Henrietta Trey's Economic Policy Director, Veda Partners. And what's so important here is Ms. Trey's has terrific legislative experience. Henrietta, I want to drill down to the president of Arlington of the 8th Congressional District, Don Beyer, the auto guy. And he is a Democrat, and he's looking at Arlington and saying, wait, we're Democrat, wait, we're not. Virginia is Republican. How does Don Beyer's job, how does his November and January change after last night's results?
I mean, you got to focus on the independents. That's all there is to it. The swing amongst independents was 13 points last night. In certain parts of Virginia. And I think that when Republicans look at New Jersey, they see the great white whale of the party's future, and they want it. So focusing on independence is what you got to do. You got to moderate and try to encourage those voters to get out and vote for Democrats instead of Republicans.
How does the congressman from Arlington or the senator from West Virginia adapt again to this election outcome? How much more power do Beyer and Manchin have today?
I mean, it is really interesting. I think that Democrats should be very thankful that there's not a Virginia Senate race up next cycle, or there wasn't one last night. I think the Senator Manchin, Senator Sinema, the moderates in the House are going to have a bone to pick with progressives and repeat something that Manchin said to them a while ago, which is you might have a quorum in the House, but you need to win more elections if you think that you are the backbone of the party. You do not have the votes for your progressive agenda. And Virginia proved that without a question last night. I mean, a 13-point swing in the electorate in less than 1 year is a huge harbinger of things to come. I would estimate maybe like 45, 50 seats in the House could be lost next year if you follow that trajectory of R plus 13.
Wow.
And so Manchin is looking at a position where I think he's going to feel really comfortable saying, put the bill in my chamber. It's my turn to write it the way that we can keep independents on board for, and you'll be lucky if we pass it.
All right, so going forward, a lot of people have been saying that this loss, both in Virginia and potentially whatever happens in New Jersey, could potentially push the Democrats to get something done. Will actually push progressives to the table and allow more things to fall out of the purview of the legislation looking to be passed through year end. Do you agree?
I mean, not to be all nerdy about it, but you need to put this bill in the Senate immediately. So whatever the progressives have now, I don't know if Speaker Pelosi can put the bill on the floor this week in the House and send it over to the Senate, but this bill needs to be in the United States Senate now, where it will be tweaked. The House has to acknowledge that that procedurally will occur, and it's going to take probably a month. So send the bill over, take a vote on it, be happy with what you've got so far, pass the infrastructure bill, send the bill to the Senate where they can make adjustments to moderate it in a way that makes Democrats be able to sell it on the campaign trail next year. They need the economy to turn around. They need inflation to get under control. They need President Biden's approval ratings to rise just to mitigate the losses.
Henrietta, a lot of people who've come on this show have said that they're expecting a $100 barrel oil next year. They're expecting it to potentially rise beyond that. Is it game over for Democrats in the 2022 elections, regardless of the talking points, regardless of what they get done, if you see prices of oil rise that far?
I mean, nobody loves a high price of gas, but I do think that what Democrats are trying to do, or what they need to do better, frankly, is get out the message about what is actually in the Build Back Better plan, and more importantly, what's in the $1.889 trillion COVID relief bill they actually passed in the first quarter of this year. The child tax credit more than offsets the benefit that families can get from going back to work. And separate the message out from inflation issues and gas price issues that are still after effects of COVID and supply chain shocks. Get that back in line and hope that you can get some economic movement selling what the benefits were from your agenda.
I love talking to you, Henrietta. You're so cynical and hard-bitten. You're just the years in Washington. The language is just different. So let me have you say some nice things here. The Oval Office arrested Biden after all that travel. Schumer and Pelosi. What do they talk about?
I mean, right now, I think you have to talk strategy about how to get this bill over to the Senate. That's got to be the number one most important thing here. You have to figure out how to roll progressives. I think they realize that they overplayed their hand. I'm sorry, I'm being cynical again, but it's true. They overplayed their hand.
Okay, so what does the senator from Vermont do? The senator overplayed his hand. Sanders is losing. How does he gracefully finesse this?
Same way he always has. I mean, there is no piece of legislation with Senator Sanders' name on it as an author. He has never passed a standalone piece of legislation in the United States Senate, and that's because he votes for cloture and then votes against the bill at the final stage. And he needs to do it again.
Do you see how she talks like that, Lisa?
It's
just cold.
Politics.
She's on the other network. She talks nicer about politics.
Oh, does she?
With us. She just
bring it out.
I promise I don't.
She's brutal. Lisa, continue. Let's see if we can make her more cynical and hard-bitten.
Henrietta, we'll stop embarrassing you. Thank you so much for being with us. You always shine, and we appreciate your insights.
Henrietta,
This is going to be really
fabulous.
interesting. Yeah,
Can't say
Henrietta
enough.
Trace.
Lisa, I'm sorry. It is so important to talk to people like that and not talking heads. I just can't convey enough the importance of that.
Especially at a time when fiscal policy is going to matter so much heading into year end. Remember when we were worried about the debt ceiling? Are we going to have to worry about that again, or does this basically take that off the table and say there has to be some consensus? There can't be any more unforced errors by the Democrats. Does that mean a better fiscal backdrop that people can kind of factor into their equation?
And now an inconvenient truth, folks. We speak to Lisa Abramowitz about all these auction.
The so what is it's the first time that the Treasury Department is reducing the total amount of coupon debt sales going back to 2016. That basically they are coming out and they are saying we can start to pare back how much debt we sell at the very same time that the Federal Reserve is saying we're going to curtail how many bonds we buy every month. In other words, it's a wash, and it's coming out at the same time. How does this then factor into what the liquidity backdrop is when the Fed is still highly accommodating?
Okay, so
that's the so what.
Can you be Henrietta Trace cynical and say Yellen's on the phone to Powell? It's like, a game of Parcheesi.
I'm happy to play Parcheesi. I'm not happy to spread rumors because I'm not going to make that connection. Michael Gapin, ran away from that one, and rightly so. The issue here is how long can this dynamic persist? When do we see the tightening that goes to potentially the when you stop dancing question?
I just, my head is spinning. Can we talk something dumb like equities?
Sure, let's talk about Avis. You selling? Everyone else is today.
I mean, that was, and there'll be a new Avis today, right?
Bed Bath and Beyond,
Zillow
that's the belief.
Well, when we should point out, folks, that all of this wisdom from Miss Abramowitz comes to her two sons who are with their new MacBook Pros on the couch at home day trading, hour trading Avis. The Fed decides. More of Lisa Abramowitz this afternoon. This is Bloomberg.
top spot as Asia's busiest airport in 2020 when passenger traffic slumped 88% from 2019. The lack of a domestic market and strict COVID rules have made for a slow recovery, and walking through the airport, the majority of F&B outlets and shops do remain closed. Here in the departure hall, long stretches still remain boarded up in areas where you would typically see throngs of passengers waiting to board their flights to destinations across the world. Only 2 lounges do remain open to travelers, one operated by the Plaza Premium Group and the other by Cathay Pacific, down from the 12 that are usually open here at the airport.
Unfortunately, when COVID had hit, we had closed a lot of our lounges and airport hospitality services. We're cautiously optimistic with the growth.
COVID certainly has forced a rethink of strategy to be nimble in the face of policy uncertainty during the pandemic era.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims
How
front.
are you thinking about those dynamics?
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
It is Fed Decision Day from New York City for our audience worldwide. Good morning, good morning. Your equity market at all-time highs. On the S&P, we pulled back about 1/10%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Farrow.
From New York, we begin with the big issue. It's Fed decision time.
We're talking about tapering.
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 Tapering. Tapering is in the books.
The Federal Reserve has done an outstanding job here in pre-signaling.
Definitely is priced in.
The FOMC meeting looks like a boring one.
Fed Chair Powell.
A little bit late to the party.
Seems like the market's a bit ahead of what all the central banks are doing.
The repricing in the front end of the curve.
Significant front-end repricing.
The downward shift in the long end of the curve.
It's a classic tale of two markets.
We need to be braced for a period of volatility up ahead.
Powell has a very difficult message to walk ahead of himself this week.
Is Chairman Powell stuck between a rock and a hard place? Joining me now is JP Morgan's Bob Michaels, SocGen's Subhadra Rajappa, and Krishna Mamani of Lafayette College. Guys, great to catch up with you. What a fantastic lineup for this morning. Let's break this one up. From taper to rates to communication. And Subhadra, let's start with the taper that you expect to be announced a little bit later.
Of course, I mean, I think taper is fully baked in. Really, the what we're looking to see is how they message around whether inflation is transitory or not. Clearly, they feel that substantial further progress has been made, both on the employment front as well as the inflation front, for them to be able to start tapering asset purchases. So, but thus far, the statement has always said that inflation is largely transitory, and that sort of changed, I would say, a little bit in the last couple of weeks when Fed Chair Powell kind of characterized it, sort of acknowledged that it might not be as transitory as they thought it would be. So the messaging around whether inflation is transitory or not is going to be very key at this meeting.
That's one for the news conference a little bit later, and perhaps in a statement too. Bob Michael, is it your sense that the taper is on autopilot if it is indeed announced a little bit later? This came from Thomas Kosterg. I'll read you the quote from him. If he emphasises that cuts are to be renegotiated at each meeting, I think markets will see a high risk that tapering could be accelerated into 22, and that would automatically bring forward the first rate hike. But what's your opinion on this? Is this a preset course on autopilot? What is it?
Well, John, it's one of the three things I want to hear from the Fed today. I want the details of the taper program, and I want to know if it's on autopilot or they'll build in a dial to go up or down. I think they should build in a dial. I also want to know the fate of the word transitory. I think Subadra's right. Does it continue in their lexicon, or does it go to the Fed Hall of Fame with other terms like irrational exuberance? And then I want to know what conditions need to be met for rate hikes. I think they did a very good job with further substantial progress. I think the Fed slogan department needs to come out with the follow-on of that. I'll tell you the one thing which would be fantastic to see today, which we're not going to get, is a dot plot. Can you imagine what that would look like today? It might look like a shotgun blast.
It could look very different to September 22nd. And Krishna, there has been a big change since then. This came from Jefferies. Markets are now implying a whopping 3 hikes in 22, another 2+ in 23, and maybe none in 24. It appears we went from inflation is transitory to the Fed should do something panicky and real quick. What's your response to that, Krishna?
Well, so the front end of the market clearly is telling you that they expect rate increases to be sooner than what we had expected before. Having said that, I think long rates are also telling you that despite our protestations to the fact that inflation may not be transitory, the markets are telling you they are transitory. If that wasn't the case, equity markets won't be where they are, but for long end rates are not going to be where they are. So I think there's a lot that the Fed can take comfort in if market prices is one of the things that they look at. And from their analytical standpoint, clearly the supply chain issues by definition have to be transitory. So Bob is right. We may be looking for change in the tone and the language from the Fed, but I think it's very unlikely that we'll get any.
You've picked up on a key point, Krishna. I want to build on it with Subhadra. Subhadra, there's a difference between pricing in higher interest rates and pricing in tighter financial conditions, because we've pulled forward rate hikes, but I don't see tight financial conditions. They're still loose, aren't they?
Very loose. So especially if you look at real yields have actually rallied quite significantly in the last few weeks because the market's pricing in much more higher inflation expectations, although that has moderated in the last week as well. And nominal yields have been very range bound. So this is sort of a risky asset nirvana, if you will, with real yields being very low and the expectation that rate hikes will come, but the cycle itself will be, the pace of hikes itself will be faster, but then the cycle might be a lot shorter. So there is a little bit of a disconnect, I would say, between what the bond market's expecting and the equity market's expecting, because equities seem to be performing well, even in an environment where the bond market seems to think that inflation expectations are going to remain high for a while. So that we need to square the circle at some point.
Hey, Bob, you talked about moving away from the T word. Do you think that happens today?
No, I don't think it does. And I think if you step back and look at where we are today, the best course of action is for Powell is to get in and out of today without jeopardizing his reappointment. And I think because of that, he's not going to do anything that could disrupt the markets.
Do you think he talks about that a little bit later? Do you think he needs to, Bob? That's the question I've been asking. If the chairman's trying to guide us through year-end into next year, how is that guidance credible without knowing who's executing the strategy, who's leading?
Well, that, of course, is the big challenge and the big unknown in the markets suddenly is, will he be reappointed or not? And if he's not, who steps in for him? Is it a Brainerd? Is it a Bostic? Those are opposite ends of the spectrum in terms of policy preference.
We heard from the president on this in the last 24 hours. Take a listen to what he had to say.
No, I'm not going to discuss it with you because that's in train now. We'll be making those announcements fairly quickly. It's been in train for some time.
It's coming soon, very quickly. Subhadra, how important is it that we find out soon?
But we have to find out soon, right? Because Chair Powell's term is ending early 2022. So we have to get a resolution one way or the other. Really, the outcome does matter, but whoever gets the job is going to be dovish, given the fact that we still have a lot of concerns on the employment front. Participation rates are very low. So I just don't see the Fed, regardless of who takes the helm, being any more hawkish, if you will. But really, the concern is going to be how policy progresses over the longer term under the new leadership, and if the change in leadership is going to lead to some volatility over the near term.
And if the change of communication, if we get a change in communication, actually sparks some volatility. This from Bank of America. We see risks that Fed comments are interpreted as hawkish due to a recognition of upside inflation risk, faster taper pace, potential future balance sheet reduction. This could sustain or extend the recent Treasury curve flattening trend. So, Badra, just briefly, you think this curve is going to go steeper. Why do you push back against that?
Well, I think something is off here, right? The market's pricing in too much by way of rate hikes, or they're too pessimistic on growth. The fact that the curve across the board, if you look at, say, 2 years, 3 years out, the entire curve is stuck around 2%. So that sort of scenario, to me, makes very little sense. I think at some point, the Fed is going to sort of push back, if you will, on the flatness of the curve. And they have tools to do that. They can not raise rates fast, as the market expects, or they could at some point try to think about unwinding the balance sheet that will steepen out the curve. So either of those scenarios, I think the Fed is not going to, I think the Fed's going to err on the side of caution and not raise rates too fast and cause the curve to flatten out too much and end the cycle sooner than people expect. So I think a gradualistic approach would mean a steeper curve eventually.
But Michael, do you agree?
I do, and actually, John, you've put together the fabulous daisy chain of bond investing today. You've got Krishna, who's the end holder of debt for his endowment fund. You've got me, who acts on behalf of end holders, and you've got Subhadra, who's a supplier of bonds to the market. And all of us are saying, we wouldn't buy at these levels. We don't like these levels. So why are we at these levels? Because of the amount of large-scale asset purchases from the central banks. And today starts the multi-year process of them exiting the market and leaving it to people like the three of us to price.
The 2 points that I'll make here, Bob. First of all, on the guest lineup, that's all down to my wonderful team. The second point that I'll make on this bond market, okay, if you've got to take down some of this supply now, Bob, because the Federal Reserve's not going to be buying as much, does the fiscal story offset that somewhat? And we'll discuss that a whole lot more in just a moment.
No, it doesn't. I think when you look at the negative real yields across the curve, they're too dramatic. Whether you want to use the word normalization or just restoring the bond market to bond market participants, either of those are fine with me. I think yields in the long end are going a heck of a lot higher over the next couple of years.
Put a number on that, Bob.
Well, I certainly wouldn't be interested in bonds over the next 6 to 9 months unless they have a 2 handle on it. If you go back to the last cycle, we got to the mid 3%. I think that's an easy to get to over the next few years for the 10-year Treasury.
You think 2 before year end, Bob? 3 into next year?
I think that's tough because even with a couple Fed tapers, they're still going to be buying in greater volume than the peak of the last cycle when they were doing $85 billion. We need for them to get more than halfway through their tapering schedule.
Krishna, if Bob comes to you and says, I can get you 2 on 10s, does that get it done for you?
Well, I think 2 is a round number, and we can get there pretty easily. We are not that far from that. But I think Bob is making a larger point, which is rates a heck of a lot higher. And I think that for that to be a credible case, you need to bring a whole lot more to the table than just the fiscal stimulus-driven growth boom that we have had and the consequent inflation driven by supply chain issues. I think for longer-term rates to be in 3.5% that Bob's talking about, where he would buy, I think the growth outlook, the structural growth outlook for the U.S. economy and the global economy has to be meaningfully better than what it is, again, away from the stimulus that we received over the last 2 years. And I just don't think it is there. I think we are getting better because of the stimulus coming out of the COVID, but structurally, we will get to the same place in not too distant a future.
You think we're going back to the 2s? You and I have talked about it before. That's right, isn't it, Krishna?
Yes, I think, again, that's what the bond market is telling you. And to some extent, that's what the equity market is telling you. The current inflationary pressures are transitory. They may not be as transitory as we might have thought earlier, but they are still transitory because they are being impacted by the supply side of the economy that gets rectified pretty quickly. So if you buy that thesis, then I think the structural story, once the fiscal stimulus fades, is back to 2%. And inflation in that sort of an environment, when China is slowing down meaningfully, I can't see a scenario where inflation is 3-4%, which is probably what you would need for rates, long rates to be in 3 and higher range as well.
Let's build on this through the opening bout. Krishna Mamani, Subhadra Japa, and Bob Michael. Coming up, the politics, Republicans seizing the moment.
Friends, we are going to start that transformation on day one.
The GOP sending President Biden a little bit of a wake-up call. That's next. This is Bloomberg. Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
I don't believe, and I've not seen any evidence that whether or not I am doing well or poorly, whether or not I've got my agenda passed or not, is going to have any real impact on winning or losing. Even if we had passed my agenda, I wouldn't claim we won because Biden's agenda passed.
Negotiations continuing on Capitol Hill, with lawmakers preparing for a potential vote on the Biden agenda. This coming amid a blow to Democrats in Virginia, with Glenn Youngkin's apparent win building momentum for the GOP.
Friends, we are going to start that transformation on day one. There is no time to waste.
Let's head to Washington and catch up with Bloomberg's Emily Wilkins. Emily, what are we more surprised by this morning? That win, or how tight the race still is in New Jersey?
I think both are pretty surprising, particularly New Jersey. I mean, we knew going into yesterday that Virginia was going to be a very close race, that either candidate had the chance to walk away with a victory. New Jersey, though, it is very surprising how close that is. That is a state that President Biden won by 16 points. And one of the takeaways that we're seeing today is exactly how much President Biden's drop in ratings has hurt Democrats potentially in these 2021 races. And it really raises the question as far as what Democrats need to do for the upcoming 2022 midterms. The gubernatorial races in 2021, they're really seen as a bellwether. And so there are going to be a lot of takeaways for what Democrats do and don't need to do. I spoke with a lawmaker last night, though, who said that it is clear now they really need to make sure that Democrats are delivering on their promises that they made to voters. And that absolutely has to do with passing both that bipartisan infrastructure plan as well as that social welfare and tax plan that is currently being negotiated among Democrats.
Well, let's talk about policy then. Final question, Emily. Did Senator Manchin get a bit more leverage overnight?
Manchin will say that he got more leverage overnight. Progressives will say that they got more leverage overnight. I think the one clear thing here is that Democrats are going to be in a they're not in a great place right now with the electorate. They're going to be in an even worse place if they can't get something done and run on it. So I think the pressure here is across the party. If Democrats want to remain control of the House and potentially even the Senate, they need to be able to actually get something done. Speaker Nancy Pelosi has suggested that a bill could move to the floor as soon as today with a potential vote, but we haven't even seen a final bill yet. There are outstanding issues and remaining on the SALT tax, on immigration. We did see some movement yesterday, getting an agreement on drug pricing, allowing the U.S. government to negotiate some prescription drug prices, fewer than most Democrats originally wanted, but they are able to get an agreement, and that piece will be a part of the overall legislation.
Emily, thank you. Emily Wilkins down in Washington. There is plenty to pass through in D.C. Here's State Street's Laurie Heinel.
We've seen this picture before, that it seems as though everything has been solidified, and at the 11th hour there are some changes. And certainly there are international things to consider here as we think about things like minimum taxes globally. There are things related to how higher earners get taxed. There are things related to business taxes. So we think there's still a lot on the table, in spite of the fact that many of the core issues seem to be coming to a little bit more of a consensus.
Let's talk taxes with Bob Michael, Subhadra Rajappa, Krishna Mamani. Krishna, let's start there. Do you assume, as you look forward, that the tax negotiation side of this story is done?
Well, I think from a political standpoint, and more importantly, from an economic standpoint, it is quite imperative from a democratic standpoint to pass something. Having said that, the net impact of that on growth prospects in the near term due to fiscal spending is going to be minimal. So this is very interesting from a political standpoint. From a real economic fiscal stimulus standpoint, it is probably not as significant as the few previous legislations that we have passed in terms of the fiscal impulse.
Bob Michael talked about the supply side of the story coming out of the Treasury. We got some news on that earlier this morning. Subhadra, can I have your thoughts on that? Does it offset what we're about to get from the Federal Reserve?
Yeah, absolutely. The Treasury is overfunded. The refunding announcement, as expected, made cuts to coupon sizes across the curve. And that comes with the assumption that there's going to be, at least in our case, we assume maybe $1.5 to $2 trillion in additional spending coming from the infrastructure deal as well as the Build Back Better plan. So, even with that already baked in, coupon issuance sizes are going to continue to decline, not just in this quarter, but throughout, I would say, the first couple of quarters in 2022, and that offsets, if you will, some of the demand that's been coming from the Fed all through this year. So it's somewhat convenient that the tapering of asset purchases is coming at around the same time that coupon issuance sizes are declining. So that should be supportive for the demand for bonds.
Mike McKee called it the twin taper, and it's perfect timing. Bob Michael, you've got the Treasury pulling back at the same time the Fed's about to pull back. You suggested that it doesn't make a difference, Bob. Can you build on that argument, where the pushback is coming from?
Yeah, I think that it's the Fed taper that's been the more dominant, and we've seen that since March, the 10-year Treasury's been in a range. When you get up to about 170, you lose the will to go short anymore because the Fed is in constantly buying, regardless of what the Treasury is issuing on any one week. The Fed and other central banks are in buying, and then when you get down to about 120, you lose the will to be long because real yields are too negative, and you start to set the shorts again, and then you're only left with Fed buying. So I think it's the large-scale asset purchases that are the relentless dynamic in the bond market, and we need to get further through the tapering process.
Bob Michael, is tapering tightening? Can I put you on the spot on that one, is it?
Put me on the spot. Without question, it's tightening, of course. If it wasn't tightening, then it couldn't have been easing monetary conditions. So if you go with the argument, it's one of the tools to provide ease and accommodation to the system, removing it is for sure tightening.
The pushback you'd get, though, Bob, is that the balance sheet's still expanding, just at a slower pace. That it's not an unwind, it's not a reversal. What would you say back to those people?
You're going to miss that $120 billion in additional purchases per month.
Bob Michael is going to stick with us alongside Krish Mamani and Subhadra Rajappa. Coming up on the program, the morning calls, and later, the US piling on the pressure on OPEC to do something about crude prices. Year to date, up almost 70%, 81.50 on WTI. What a move we've seen this year. The political pressure is building, and they are palming this one off to OPEC Plus. We can talk about that in just a moment. From New York City this morning, good morning. This is Bloomberg.
The past 18 months have reminded us how essential the PC is to work, life, learning, and connecting. And with Windows 11, we have renewed sense of the role Windows plays in the world. It offers personal agency and real choice to users.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Let's set the stage for this one. Going into the opening bound, 5 minutes away, equity futures come in about 1/10% on a 4-day winning streak on the S&P. All-time highs, just a little bit of softness on this Fed decision day. The focus in the bond market at the front end of the curve. Switch up the board, it's twos. Twos have gone from 20 basis points to through 50 basis points since the last Fed meeting, September 22nd. Right now, yields up about a basis point or so after pulling back yesterday. Let's call it 46 on the 2-year. That's the price action here at the morning calls. Let's start with Goldman, adding Phillips 66 to its conviction buy list, remaining constructive on the stock's valuation and company's non-refining business. That stock is unchanged in the pre-market at 77.55. JP Morgan downgrading Avis budget to underweight from overweight, seeing limited upside after shares more than doubled
yesterday, one day. Today we're down 12.65%. Your final call from Raymond James upgrading T-Mobile to a strong buy after earnings, highlighting the stock's favorable risk profile and strengthening outlook. Positive there by almost 5%. Coming up on the program, we'll look at energy. President Biden keeping the pressure on OPEC ahead of its policy meeting. The opening bell on this Fed decision day is up next. From New York, this is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
24 seconds away from the opening bell this morning. Good morning to you all. Let's get to work, shall we? Ahead of that Fed decision. This equity market comes in about 1/10%, down 6 on the S&P 500, -2 on the Russell. We're down 1/10 there. Positive on the NASDAQ, up again. This time by 17 points, up by about 1/10%. That's the opening bell. Switch at the board and get to the bond market. Going into Chairman Powell and that decision a little bit later. 10s look like this: 153.66, yields down a basis point. Will we get the pushback from Chairman Powell on rate pricing? We had it a little bit earlier from ECB President Christine Lagarde. Euro dollar 115.72. We're negative there, almost 1/10%. Just a touch, a flavour, a little bit of euro weakness. So the commodity market, we'll talk a lot more about this in just a moment. 81.39 on WTI, call it 81.40, -3 percentage points now as the pressure continues to build on OPEC Plus to do something, anything to help this administration out. At the opening bout, your equity market slightly negative. We're down by 0.04%, just a little bit softer here. Energy bottom of the par, reflecting what's happening with the underlying commodity. Crude lower, energy stocks down by 0.7%. One name I want to discuss is Zillow, getting absolutely hammered in the pre-market. Let's try and get an opening price on Zillow this morning, down by 14 percentage points. The home flipping business is difficult, apparently.
according to Zillow, unable to predict prices well enough to flip safely. We wanted to be a market maker, not a market risk taker. That stock is getting absolutely hammered by 14.5%. We'll stay on top of that story through the morning for you. Still with us, Bob Michael, Subhadra Japa, Krishna Mamani. Krishna, on this equity market, you said something interesting in your notes. You said it's unlikely you'll see positive returns in this equity market with continued value outperformance. Krishna, why?
Well, so I think for value to continue, or value to outperform rather than continue to outperform, I think you need real rates that are meaningfully higher than where they are today. And if that happens, the likelihood that the equity market continues to be where it is basically zero. If real rates get as positive as Bob would like it, then there'll be hell to pay on the equity market because what we are building in is expectations that real rates are going to remain low for the foreseeable future. One part of it is inflation today, but the other part is rates remaining low for the foreseeable future, even through this non-transitory, transitory period.
Bob just wants to lend you a helping hand, Krishna. You know that, and find you some real yield. Right now, Wells Fargo's Chris Harvey said this, Krishna. For him, it all comes down to real rates as well, but he's taken the other side of the trade, seemingly. Our trading call on tech may be at risk, especially across high-octane names. The Fed's anticipated taper announcement this week may potentially catalyze a significant directional change in real rates. We believe the eventual real reversion will be sharp. Krishna, just sum it up for us, and then I want to get the thoughts of Bob and Subhadra off the back of this. Why do you think we can stay down here, negative 1%?
So I think you can't have it both ways. You can't classify it as non-transitory and then expect real rates to rise meaningfully. So I think something has to be squared here. And I think the way the equity market and the bond market are basically telling you the same thing, if you want to kind of derive that, and that is that, the markets will see through the near-term transitory issues. It's just that the economy is going to slow down meaningfully, Fed-induced or otherwise. And in a combination, it'll be even sharper than that. And then, therefore, real rates at that point, nominal rates would remain low, and real rates would not rise as substantially as some of us may want it to.
Bob Michael, weigh in.
Yeah, I think the concern for all asset prices is every asset has some sort of discount rate applied to it. So as the Fed begins the liftoff process and rates all go higher, then the discount rate for every single asset class has to go higher, which lowers the terminal value. But from 2015 to 2018, the Fed proved that it can do it. It can taper, it can lower the size of its balance sheet, and it can raise rates without disrupting the markets. And that's what we saw from that period. Markets were a little bit choppier, but they still went up in price, particularly risk markets.
Subhadra?
That's exactly right, because what you really want to see is a gradual repricing higher in real yields, modestly higher inflation expectations and higher nominal yields. That, to me, is a healthy market. Where we are right now with real yields at negative 1% doesn't make a whole lot of sense, because a lot of these assets in the fixed income world have negative real returns, and it just doesn't make any sense. It's a huge cost on savers, and this is not the paradigm we should be aspiring for, where real yields remain extraordinarily low, and you see the sort of excessive risk-taking, if you will, in all the other risky asset complex. So that needs to change, and a gradual repricing higher in real yields is a good thing.
5 minutes into the session, this is what the equity market looks like, negative 0.1% on the S&P 500. I want to talk about a single name here. It's Bed Bath & Beyond. The company expecting it to complete its $1 billion share repurchase plan by the end of the fiscal year in February, 2 years ahead of schedule. I'm not sure how much it's that and how much it's other stuff too, but this stock is rallying hard up by 37% in early trading 5 minutes into the session. That's a single name story. Let's get to a single industry, a sector, energy. I want to talk about oil. We've talked about it all through this morning. Crude is up by 70% so far this year. President Biden, his administration, is piling on the pressure on OPEC Plus to do something on the supply side. Take a listen.
If you take a look at, gas prices, and you take a look at oil prices, that is a consequence of, thus far, the refusal of Russia or the OPEC nations to pump more oil. And we'll see what happens on that score sooner than later.
We will. With more, here's Kelly Lyons. Hey, Kaylee.
Hey, John. Well, I don't think the irony is lost on anyone that the president is in Glasgow at the COP26 summit, a summit focused on climate change and reaching carbon neutrality, and at the same time is asking oil producers to pump more oil. But that is really just the reality of the moment we're in, as contradictory as it may seem, considering the president is balancing what's going on in the international stage and then also the domestic pressures at home, those being higher prices at the pump for American consumers. The average gallon of gas at $3.40 right now, which is the highest going back to September of 2014. And of course, what's driven those prices up is higher crude prices, both WTI and Brent holding above $80 a barrel, more than doubling over the last year. And yet, even as oil prices have rallied, you haven't seen OPEC really pumping that much more. They have maintained a gradual approach to adding production back online, reluctant to boost output too much and risk upsetting the market. So we'll have to see if tomorrow's meeting they stick with the plan, proceed with that 400,000 barrel a day increase for the month of December, or if they cave to these political pressures. And the thing is, if OPEC stays the course and prices stay elevated, not so great for American consumers who have to fill up their cars, but pretty good for energy investors. Of course, with the oil rally, energy up 53% year to date, leading the sectors within the S&P 500, actually doubling the gains we have seen for the broader index. And it is the exploration and production companies in particular that have benefited the most. The top 4 performers in energy year to date, John, all up 100% or more. The likes of Devon Energy up 171% year to date, John.
What a move. Kelly Lyons, thank you very much. Before we move on too quickly, can we get that up again and just have a look at that graphic? The year-to-date performance on a sector basis so far in 2021, breaking down the S&P 500, energy up more than 50%, the financials up by 37%, real estate 32%, IT 25%, the S&P 500 23.3%. And I'll repeat something I said earlier this year. I said it repeatedly through the summer. The problem with this year is that people weren't bullish enough. And at the end of last year, when I saw the year-ahead price targets and everybody was scratching their heads, I was laughing too. And we were talking about 45, 46 maybe. Here we are at 46 on the S&P 500, and that seemed insane. And now people are talking about 5K next year, and people are sitting here saying, that doesn't seem right. Here we are again. Can we do it again? And as Lisa Abramis has talked about through the morning, is that the pain trade here, that equities just keep going higher? Bob Michael, I want to talk to you about the oil trade and the energy component of this fixed income story. Bob, can you weigh in on that? Just walk us through it, the energy component of the fixed income story we've experienced through this year.
Well, before I get taken off the pitch here, I think this is a good spot to submit a candidate question for Mike McKee related to this. He should ask the Fed, how should the Fed reply to supply shocks? Because we've seen this before. We saw this in 2008, which was the greatest gaffe in central bank policy I've ever seen, when the ECB raised rates as the world's property markets were imploding and as the world economy was stagnating. And they did it because oil prices had risen from $40 to $140 a barrel because of the non-OPEC countries cutting production. And here we are in a different environment. And this is the conversation we're having with clients. They're struggling with this. What should the correct central bank policy response be? Back in 2008, maybe it was to ease and provide some accommodation for the spike in energy prices because everything was imploding in the global economy. This time, I think it's different. I think the central banks are supposed to be more adamant about raising rates. There's plenty of growth. There's plenty of expansion. There's plenty of fiscal policy. They need to raise rates so that the cost of funding goes up, and that dampens some of the demand.
Bob, you're too kind, because they didn't just do it in 08. They did it again in 2011, didn't they? With Trichet, before Draghi came on board. They didn't just do it once, they did it twice, going into the next crisis over in Europe. You said it was a supply shock. I want to build on that a little bit more. Subhadra, is that the best way of summing this up? Or is it both the demand shock and a supply shock that we've witnessed this year?
Yeah, and definitely on the inflation front, it's both demand shock and a supply shock. If you just isolate commodities, then it feels much more like a supply shock, like what we experienced back in the 70s. But as far as the bond market is concerned, you're seeing a lot of volatility in inflation expectations in both 2-year and 5-year break-evens because of the sharp rise in commodity prices. And this has not just been a U.S. phenomena. It's been a global phenomena with UK and European sort of inflation break-evens in those countries also rising sharply. And if anything, U.S. break-evens are playing catch-up, if you will, with what's happening overseas. And this has, again, muddied the picture, if you will, on inflation expectations or market-based measures of inflation that the Fed tracks very closely. The 5-year forward, 5-year break-even rose quite sharply in the last couple of weeks, and it's come back down to around 220 right now. So, you know, the signaling there becomes a lot more muddied in an environment like this.
This is a fascinating moment. This really is a fascinating moment, and I want to wrap it up here. For much of the last 12 months, in fact, the last 18, we thought this Fed would be conditioned by the experience post-2010. Bob Michael was alluding to that. Maybe conditioned to be a whole lot more patient. Now I hear the conversation shifting back to the 1970s. I don't think any of you are suggesting that we're going there, but this is a Federal Reserve that should be maybe thinking about tightening interest rates. And I want to finish on here with a simple question for you all. Do you think the biggest risk right now is that the Fed acts or does not act? Krishna, you first.
I think the biggest risk is the Fed gets muscled by the markets and gets muscled by the inflation prints that we see in the near term. And as a result, kind of forgets what the structural issues are going to be 2 years down the road. So yes, they need to tighten some, and they will do that with tapering, and maybe they bring in the tightening forward a little bit. But if the tightening when they actually get going is significantly faster and harder, that will be a problem for the global economy. And I would say that the right model for kind of evaluating that is really Trichet rather than what the ECB did in 2008. The structural issues haven't gone away, and they will come back to bite us once we are through the COVID period.
Bob Michael, same question to you.
Not removing the emergency policies that had been put in place could be their biggest mistake. And by the way, when the 10-year Treasury hits 2.5%, Subhadra and I are going to pile in a car and drive down to Lafayette College, and we're going to see if Krishna is stuffing the endowment fund with 2.5% debt. If he is, we'll buy lunch. If he's not, he's buying us lunch.
I'll come with you, and I'll record the whole thing. Subhadra, a final word.
Well, I think monetary policy is very accommodative, right? Like Bob said, interest rates are very low. They've been buying asset purchases. The balance sheet's going to be $8.5 trillion when they're done. So monetary policy is definitely very, very low. But that said, I'm not sure that raising rates too soon or too fast to respond to this kind of demand dynamic-led spike in inflation, where they don't really have full control on supply chain disruptions as well as issues related to labor market shortages, is a wise thing. So I think that a much more gradualistic approach is what they're going to take, and that's what they should do as far as policy is concerned in tightening monetary policy.
This has been fun, guys. Let's do it again. Lafayette College is going to pay. They're going to pay for the trip down, Bob. Bob Michael, Krishna Mamani, and Subhadra Japa, thank you very much. What a fantastic lineup on this Fed decision day. Let's get to the trading diary. Your day ahead, your week ahead. The focus on monetary policy, the Fed rate decision, 2 p.m. Eastern Time. A Chairman Powell news conference 30 minutes later, and 30 minutes before the decision, full coverage right here on Bloomberg, on TV and radio. Then tomorrow, it's a Bank of England decision that we are told by the chief economist on Threadneedle Street that it's a live Bank of England decision, plus another round of initial jobless claims. And then finally, we round out the week with the US payrolls report on Friday. From New York City, an early finish for me this morning. This was the countdown to the open. Thank you for choosing Bloomberg TV. This is Bloomberg. Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Hey, Dad. Miss us?
Reflect on the past, celebrate the future. Season's greetings from Audi.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com webinars.
Мы хорошо подготовлены, насколько это было возможно за столь короткие сроки. Это на самом деле эксперимент. Поэтому мне не хочется употреблять такие слова, как страх, боязнь и все прочее. Мне хочется говорить, что это очень волнительно, но одновременно и радостно, потому что, вы же понимаете, как мало людей вообще там были. А у нас есть возможность полететь в космос, и не просто полететь в космос, а сделать там то, что мы умеем по-настоящему хорошо делать на Земле. Это снять кино.
Дело-то. У нас же экспериментальный во многом этот проект. Поэтому мы сейчас столкнемся с кинематографическими нюансами, которые мы могли предвидеть отчасти, какие-то, наверное, не могли предвидеть. То есть, несмотря даже на то, что, опять же, все делились с нами там космическим опытом и так далее. Но это опыт, это первый раз. То есть второй будет проще.
Television and radio.
We are on the verge of a disaster.
Join us live from Glasgow for coverage of the COP26 Climate Change Conference.
People are beginning to build some momentum, I think. The question is, will it be enough?
We'll speak with global leaders, keep you up to date on progress and setbacks, and analyze what it all means to you.
We're going to need to see some real action.
COP26, the UN Climate Change Conference, this week on Bloomberg Television and Radio.
For Bloomberg Television, I'm David Weston. I'm delighted to welcome now the new mayor-elect of the city of New York. He is Mr. Eric Adams. Thank you so much, Mr. Mayor-elect. First of all, congratulations. It's not a big surprise. I'm sure it's nice to have it behind you. But you've had some time now to think about what you're going to do. Give us a sense of your priorities. And let me be specific. As you know so well, leadership often is driven by people. What are the first big appointments you're anticipating?
Thank you so much, David, and thank you for being here and allowing me to be on and share my vision for my city. And the vision did not come about this during the campaigning or during the election. It's something that I've watched from the days of being a rookie police officer. I saw how our city abandoned the everyday New Yorkers and people. And I want to focus on turning around just the dysfunctionality of our city, and it starts with being safe. And I'm going to make sure in my first few days to appoint the right police commissioner, the right chancellor, and make sure I have people over at the Department of Buildings, which play a major role in the economic stability of our city. And those are some of the key places that I'm looking at. And finally, to make sure we have an amazing person there at HRA to deal with those families that are in need of city services.
So that's very helpful when you identify the police commissioner and the city schools leader. That gives us a sense of what some of your priorities will be. Give us a sense of what sorts of people you need in those two jobs to accomplish what you want to accomplish.
You know, that is so important, David. You know, I don't get that question enough because people think that you can look at academics or you can look at the fact that someone was in a particular field already, that they automatically can fall into that job. And I say no to that. I use a term often called emotional intelligence. I don't want your academic abilities. I want to know, are you empathetic? Do you have the compassion to change the culture within our agencies? Cities are made up of agencies, and if they're dysfunctional and siloed, it doesn't matter how many taxes we pay. We're never going to get the product that we deserve, and that's what you're seeing in New York and across the entire country.
The position of mayor of the city of New York is a powerful one, but it also is many-faceted. You have to really accomplish more than one thing at a time. Give us a sense of how you can accomplish two things at the same time. One is bringing the city back economically and in terms of businesses. We walk around, for example, Midtown Manhattan, a lot of empty stores. We also see a lot of...
Hello, traders. It's time to place an order to buy British pound. And I'm looking to buy at 136. 41.6. Okay, order placed 136, 41.6. This is the price. If you're looking to trade British pound, please copy this trade, please place your order and stay with me. We will go through this trade until the end. We will collect the profit and I'll let you know what we're going to do next. It's look like it doesn't want to fill my trade. Let's see if I'll be able to fill this order at this level. If not, maybe, just maybe, I will move a little bit higher. Let's see if I will be able to fill this order at this level. Okay, I will move higher my order to 136.42. Okay, guys, let's move order at 136.42, and I'm waiting, still waiting. Hope you have a good day, guys. It is very busy day right now on our side. On your screen, maybe it's not that busy. If you want to get the strategy, you will see what it does, and you can trade other pairs, forex, or indices. Unfortunately, we can show you only one screen. So no, we didn't fill. We're still waiting until it just touched a little bit and it moved away. And no, we didn't fill yet order. If you guys managed to fill the order, well done. But for us, we have quite large orders, so unfortunately we didn't fill it. Okay, so what I wanted to say, so if you want to get the strategy, you need to go from company.co.uk, so you can see what you can trade and how you can trade other securities on margin, and you don't have to stick to one screen that we show you on YouTube. Okay, guys, stay safe. I'll speak to you later after we will get filled this order. Okay, guys, stay safe.
First is for the budget. And a question I have, I think a lot of New Yorkers have, is can you afford to do everything you're doing now with the current tax base? Is raising taxes on the table?
Well, before we talk about raising taxes, we have to ask ourselves, what are we doing with the tax dollars we have now? I believe that we need to go into all of our agencies and find cost savings. It's something called a PEG, Program to Eliminate the Gaps. I think there's just too much waste and mismanagement, and I think in some cases fraud. And we must put in place a system to identify it and give a clear direction to all of our agency heads. You will find that 3 to 5% cut in your agencies. And once we run our city agencies more efficiently, you're going to find out that a $98.7 billion budget can provide the goods and services that we are supposed to provide for New Yorkers.
Cost savings sounds like a very good idea. Can you reconcile that with a lot of union contracts coming up, including DC 37? You got a lot of support from the unions. What's it going to be like negotiating with them?
And listen, I'm so proud of the support, and believe it or not, we need our union people. No layoffs, no furloughs. We're not going to challenge our safety net system. When you think about those DC 37 workers, you know who are they? They are the homeowners. They are the condominium, the renters. That's the foundation of our city. The more we do for them and keep them stabilized, we will ensure that our city is stabilized. Those are the police officers, the firefighters, the EMTs. And so, yes, I believe we can come to the table and be fair in a contract negotiation and stabilize that middle class of the city. We often ignore the middle class. We look at the low-income New Yorkers, and the high-income earners are doing fine, but the middle class is something that's being decimated.
Let's move, guys, a little bit higher. I'm going to move order to buy at 136.42.5. Okay, I moved a little bit higher because just we want to purchase these pairs, British pound against United States dollar forex pairs. So that's why we're trying to chase, you can say, these securities, these forex pairs. Stay safe. I'll speak to you later.
First call to tell her thank you, Mother.
That seems only fitting. One quick last one. You're going to live in Gracie Mansion?
I'm not sure yet. I may spend some days there. I may spend some days over at my house in Bedford-Stuyvesant. I may kick up my feet like I do now, just sleep right in City Hall so I can get up early to execute my plan.
Okay, thank you so much. That's New York City Mayor-elect Eric Adams. And this is Bloomberg.
Is there at the moment amongst the asset managers that actually some of the ESG labeled products, then if you probe, are not green?
Well, look, there is some stress, and it's great that there's that scrutiny, and there's that skepticism or healthy skepticism about ESG labels or sustainable labels. And that, again, is one of the reasons we're having this ruthless, relentless focus on net zero, because in the end, look, we can't stabilize the climate unless we get to net zero. And it's a simple, these are hard numbers. Your emissions are either A or B. They're going up or down. And if they're going down, are they going down consistent with the science? We anchor it in the science, the same science the UN and others use for the 1.5 degree objectives.
Should this not be compulsory? Should we not have regulators coming in and saying, look, this is a new definition, you stick by it, and we're going to measure it?
So I think it's a great question. So let's look at what happened with TCFD, climate disclosure. 6 years ago, you and I were in Paris. We talked about this. We talked of other things. Now that's moving to become mandatory.
I was just finishing what you were saying, Tom. November 3rd is when the decision is. Just in case people got confused, I will. Just one more story, Tom.
Yeah, thank God for that.
We're at 137 right now. It's a weakness. Is this where they play the music and the Academy Awards? Is this it? Do I thank my mum again? Are you in charge of this?
Is she the only one?
Kill the music. You know who's in charge here.
You talk about hiring aggressively at the moment. Can you walk me through how challenging that is at the moment? How difficult is it to find the right people?
Well, things have changed. Again, the world has changed under the pandemic, and you all know worldwide, what the challenges with getting people back into the workforce.
Okay, guys, position opened at 136.42.5. Okay, long position. Stay with me. If you manage to open position at this level, and stay with me, I will guide you through. We'll go until the end of this trade and we'll collect the profit. Okay?
Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan, and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water. It's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He said things of life happens. Yeah, I'm here by myself. So ¿dónde vive acá? En la parte de... This is not a job. If you do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through jeevansaathi.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. jeevansaathi.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from traditional caste community conservative parameters to something like which is more focused on education, employment.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other.
So what's the emoji like you use the most to send to each other?
So there's a bear which basically we use for indicating a hug.
Yeah, that's our language basically, bear icon for a hug.
Time flies when you're in love, and just 1.5 months after they first met online, the couple got engaged. They decided to hold their wedding less than 3 months later. But planning a traditional Hindu wedding on such short notice is no easy task. The massive event usually lasts 3 days, has various ceremonies and celebrations, and involves the entire two families and hundreds of guests. Luckily, there are websites and apps for that.
We searched online, we got in touch with Wedding Brigade, and they helped us finalize the venue. And it makes the search faster and efficient.
Startups like the Wedding Brigade are challenging traditional wedding planners in this $50 billion industry. It provides various services from booking banquet venues to buying wedding gowns. The website makes money by charging commission from vendors.
People don't want to be limited to what is available around them. They want to know the entire range of options available before making a decision. And now it's easy to find almost everything on one portal.
Anshu and Sumit are officially married in a ritual that has gone on for thousands of years, but their love started in a very new way. Technologies might be changing the way couples meet, date, and get married in India, but they're definitely not changing everything.
The technology was only the first level help that we could get to find each other. Everything else was like very humanly and emotions and feelings based.
Massachusetts Senator Elizabeth Warren has become a symbol of everything the Republican Party stands against.
Everyone gets a right to basic health care. We need strong oversight of these banks.
A legal scholar and a consumer advocate turned politician, Warren has branded herself as a champion of the working class and made a career out of standing up to big business. While rumors of a 2020 presidency bid remain just that,
I'm not running for president.
her Senate seat is up for re-election in 2018, and Republicans are already pumping millions into super PACs to defeat her. This is the story of how a law professor and politician came to be seen as the biggest threat to Republican values and the greatest hope for progressive America. Elizabeth Warren was born Elizabeth Ann Herron, the youngest of 3 siblings, on June 22, 1949 in Oklahoma City to middle-class parents. After waiting tables to help her family pay the bills, Warren became a star on the high school debate team. She landed a scholarship to George Washington University at the age of 16, but 2 years later dropped out to marry her high school sweetheart, Jim Warren. By 1980, Warren was a mother of 2, divorced and remarried, had earned a bachelor's degree from the University of Houston, a juris degree from Rutgers, and practicing law in New Jersey. Warren then went on to become an influential law professor, teaching, lecturing, and publishing highly cited work on bankruptcy and commercial law at 7 universities around the country, eventually settling at Harvard Law School. But Warren wasn't always a liberal lion.
Elizabeth Warren used to be a Republican, actually.
That's Stephen Dennis.
I'm a Senate reporter for Bloomberg. Around the time that Elizabeth Warren switched parties, she became a fierce opponent of a Republican drive to make it much harder to file for bankruptcy. She fought that for a decade. It ended up passing anyways.
While her efforts ultimately failed, her warning calls were heard in 2008.
We're in the midst of a serious financial crisis. Our entire economy is in danger, and without immediate action by Congress, America could slip into a financial panic, and a distressing scenario would unfold.
Professor Warren was tapped to help with oversight in the government bailout.
She would excoriate bankers and their bonuses and their practices.
Why should the U.S. taxpayer alone carry city?
She proposed a series of tough regulations, which became the basis for much of the Dodd-Frank financial law that we have today. That sort of catapulted her to national stardom, particularly among the progressive left.
Encouraged by her newfound notoriety, Warren declared her bid for the U.S. Senate on September 14, 2011. During the race, her opponent Scott Brown tried to derail Warren by accusing her of falsely claiming Native American heritage, a controversy that earned her the nickname Pocahontas. Nevertheless, she was victorious and won the Senate seat by a comfortable margin. She used her new tenure to challenge everyone, from banking regulators and Treasury officials to members of Wall Street and Congress.
I'm really concerned that too big to fail has become too big for trial. We need tough new laws to hold corporate executives personally accountable. No one should be above the law.
She called for Wells Fargo CEO John Stump to resign for fraud, introduced the Bank on Student Loans Fairness Act, and reintroduced the 21st Century Glass-Steagall Act. In 2016, after staying silent during the Democratic primary battle, Warren finally endorsed Hillary Clinton and had some harsh words for candidate Trump.
Donald Trump is a loud, nasty, thin-skinned fraud who has never risked anything for anyone, and that is just one of the many reasons he will never be president of the United States.
But she was wrong.
The forgotten men and women of our country will be forgotten no longer.
Warren wasted no time resisting Trump's agenda.
Have you ever managed or overseen a $1 trillion loan program?
I have not.
How about a $1 billion loan program?
I have not.
Okay. In the Donald Trump era, Elizabeth Warren has been playing defense and trying to prevent Donald Trump and his cabinet appointees from rolling back protections that she helped enact.
Warren actually found herself rebuked by Mitch McConnell for reading a letter by Coretta Scott King about Jeff Sessions' record on racism during his confirmation.
She was warned. She was given an explanation. Nevertheless, she persisted.
That moment became something that's on T-shirts, bumper stickers, slogans, and that really galvanized a lot of support for her. It's been very hard for Republicans to get much of anything done this year, and that's at least in part to this resistance movement that Elizabeth Warren has helped champion.
We are here to fight back.
Enough of Elizabeth Warren. Like you.
Millions of dollars are being funneled to defeat Warren in the midterm elections in 2018. But it's the rumors of a 2020 presidential bid that has further prompted powerful donors to fund her opposition, often using the same playbook of constant and ruthless ad campaigns that many believe helped Trump win in 2016. It's anyone's guess if she will endure what Hillary could not.
You know, the question for Elizabeth Warren is whether she can go from being a liberal firebrand to somebody who can regularly get 60 votes for initiatives in the Senate and 218 in the House and drive an agenda, and whether she can bring together coalitions for political victories. That's the challenge, and we'll see what happens.
Sadiq Khan, the mayor of London, has made some powerful opponents.
He doesn't know me, never met me, doesn't know what I'm all about. I think they're very rude statements, and frankly, tell him I will remember those statements.
My message to Donald Trump and his team is that, your views of Islam are ignorant.
He's the first Muslim mayor of a major Western capital and proud of it. This is how Sadiq Khan went from the son of Pakistani immigrants to a lawyer, lawmaker, and now the mayor of London. Khan's parents emigrated from Pakistan. His father was a bus driver, his mother a stay-at-home seamstress. The 10-strong Khan family squeezed into a 3-bedroom flat in South London. He wanted to be a dentist, but TV in the 1980s convinced him otherwise.
Objection!
LA law, with its swagger and ill-fitting suits, caught Khan's eye. He graduated in 1991 with a degree in law from North London University and joined a human rights firm. Khan worked a number of high-profile cases, often clashing with London's Metropolitan Police Force. But he had bigger political ambitions.
This is what being a new MP is like, squatting on a bench in the absence of an office, dealing with letters from constituents.
Reports are just coming in of an explosion here in London.
So there's just explosions, and then it was just smoke everywhere.
Everyone's just asking what's happened.
Only 2 months after Khan entered the Commons as a Member of Parliament, London was attacked by Islamist extremists.
That day will stay with me for the rest of my life.
He spoke out against the attacks both as a London MP and as a Muslim.
He has been very clear about his opposition to violence, opposition to terrorism, and has set out to make the case for a more open and peaceful Islam.
That's Thomas Penny, one of Bloomberg's Westminster correspondents.
Here is a man who is a Muslim, and he is standing up and being open and straightforward and being clear that the problem here is not Islam, but it's Islamic extremism.
In 2015, a decade after the attacks, Khan ran for mayor of London, and his faith was back in the headlines. His opponent, Zach Goldsmith, trying to link Khan to radical Islam.
The debate got again personal and nasty. The Goldsmith camp has called Khan extreme and accused him of associating with, quote, those who seek to do our police and capital harm.
It's a pattern of behaviour.
Even the former Prime Minister David Cameron repeated the allegations.
He shared a platform with Sajil Shahid, the man who trained the ringleader of the 7/7 attacks and accused the United States of bringing 9/11 on themselves.
But the smears didn't stick.
Zach Goldsmith ran a very negative campaign that was based on what people knew was a lie.
This election was not without controversy. And I'm so proud that London has today chosen hope over fear and unity over division.
After taking the mayor's office with a comfortable majority, Khan has brought a business-like efficiency to the role, scrapping expensive vanity projects like the Garden Bridge and the new Routemaster buses, which cost £350,000 each. The former lawyer who used to fight the police in court is now praised for his close relationship with them.
I was talking to a very senior police officer in the Metropolitan Police who said there was a sea change when he went into City Hall, and the police were saying how much they welcomed this because they knew where they stood and it was more straightforward to work with. So he works like a lawyer, he works like a government minister.
Khan's kept his faith at the fore. He's an outspoken voice for moderate Muslims across the world.
Donald J. Trump is calling for a total and complete shutdown of Muslims entering the United States.
Now, by giving the impression that Islam and the West are incompatible, you're playing into the hands of the extremists.
The ongoing spat between Khan and US President Donald Trump escalated when Trump went after Khan, misquoting him on Twitter just hours after the terrorist attacks of June 3rd, 2017. Khan's now one of the most prominent Labour politicians in the UK. In fact, a recent poll of Londoners found Khan was more trusted to keep the country safe from terrorism than the Prime Minister or the Labour leader. His story of going from the son of an immigrant bus driver to the mayor of one of the greatest cities in the world plays well with Londoners. But can he appeal to the rest of the nation? Has Khan got his eye on the top job? And is the UK ready for a Muslim Prime Minister?
What does it take to change the world? A big army? A cure to a pandemic? A revolution? All of these take either a lot of people, thousands of hours, or massive amounts of space. But for Julian Assange, all he needs is one room, an internet connection, and the world will listen. Assange is located here, and more specifically, right here. And from that location, he's posted government secrets, classified documents, and leaked emails from some of the world's most powerful people. And in doing so, has been labeled a hero, a villain, a nihilist, and everything in between. This is how an Australian programmer sequestered in the Ecuadorian embassy in London became one of the most influential and notorious people in the world. Born in 1971 in Townsville, Australia, Assange has always been on the move. Living in over 30 homes by the time he was in his mid-teens, Assange, along with his mother and half-brother, finally settled down in Melbourne. His introduction to hacking started at 16 when he was given a Commodore 64, which he attached to a modem. He attended the University of Melbourne, where he studied programming, physics, and mathematics. He never graduated, but that doesn't mean he didn't get an education. By 1991, Assange hacked into the Pentagon, U.S. Navy, and other branches of the U.S. government. In 1996, he was caught by the Australian Federal Police and charged with over 30 counts of hacking and computer-related crimes. He didn't get any jail time, but he was fined $2,100.
I think the first taste of what would come later was the hacking that he did as a young programmer, and that really sort of foreshadowed a healthy skepticism of the use and abuse of technology by governments.
That's Vernon Silver.
I'm a reporter for Bloomberg's investigations team.
Assange's youth as a hacker laid the foundation for him to start WikiLeaks in 2006. But what is WikiLeaks? It's a website that posts unfiltered, usually classified documents. What separates it from every other media outlet is that they have no editorial hierarchy. With a publication like the New York Times, information comes in, they take that information, package it, then disseminate it for the public to see. WikiLeaks, however, cuts out the middleman.
WikiLeaks gathers information, most of it given to them anonymously. So what they're doing is really very simple. They get the information in one end from who gives it to them and out the other with sometimes minimal interference. Julian Assange is the leader of that, the mastermind, the creator, and really, because he thinks of it as a journalistic enterprise, the editor-in-chief.
But every story starts with a source, and Assange has some unconventional sources.